Hi, everybody. Good morning. Now that John's put the pressure on that this isn't supposed to be dull, bear with me because I haven't done one of these in 3 years. As a matter of fact, the last one I did was for John in April in Chicago in 2012. So it might take me a while to get going. So hopefully it won't be dull. But anyway, I think the way I want to start out is by answering a question that a lot of you guys, not a lot, the few people that I've talked to yesterday and a few people I talked to last night were asking me that I'm writing a third book. And I guess I should ask you first, have a lot of you read Trading in the Zone or The Disciplined Trader? And so you're probably wondering, well, why am I writing a third book, right? Would that something become to your mind? Yeah. Okay, like why am I doing that? Well, okay, here's the reason why I'm doing it. About 8 years ago, I was asked to speak at a trading conference that was going to be quite large. Be about 5,000 or 6,000 people were expected to attend the conference. It was going to be in Texas, and if you people have been in this business for a while, you'll know that there's a lot of people that just aren't that ethical. I mean, there's a lot of ways that people can be taken advantage of in this business, and there's a lot of people that understand that, a lot of people that exploit people who want to become traders. And so as a result, I didn't want to be associated with somebody or an organization that fell into that category. And I asked them to, and I knew they had user groups all over the country, and so I asked them if I could attend some of their user group meetings to see just how well they lived up to their claims of customer service and the kind of products that they offered. And so they had a pretty substantial user group in the Phoenix area, and I attended. There were probably a little over 100 people, maybe 110, 20 people, and I was just kind of taken back. One, everyone was really enthused with this company. They really loved the product. They loved the customer service that they were providing. And but the other thing I was taken back by was just how absolutely, totally clueless they were. And because I was used to working. I started coaching in really around 1982 or 1983, and most of the people that I worked with were like floor traders, the Chicago Board of Trade, Chicago Mercantile Exchange, and then later on a lot of hedge fund managers, and people who fell into the category of what I call professional traders. I mean, people who are diehard traders. And so actually my coaching clientele kind of fell into two categories with nobody in between. In that I had the professionals, people who had been in the business for a long time, and they understood just based on their experience the importance of their state of mind and their psychology played on their results. So there wasn't any convincing them, that this was the direction they needed to go. And then at the other end of the extreme was the person who had been in the business for probably quite a while, lost usually a lot of money, lost their account several times, and they're at the point of what I call total and complete exasperation, where you might want to think of someone being on an alcoholic bender, and they wake up with their head in the gutter, literally their head in the gutter, and they look up and they say, okay, God, I'm ready, I'll do anything. And they mean it. It's not lip service, it's not bullshit, they really mean it. I'll do anything. And so I didn't have anybody in between because they didn't realize what they were getting into. Okay? So basically, this group of people in the user group, they were all these in-betweeners. And not only they were just in-betweeners, none of them were professionals. They were like, just really what I call nice people. But I mean, not that professional traders can't be nice people, but they're a breed apart. They really are. They're, I'm not going to get into that. But in any case, they're different. But, so I'm thinking, you know what, I have to write a book for these people. I just, because the disciplined trader and Trading in the Zone did not really address the issues in a way that someone just starting out in the business could relate to. I made a lot of assumptions writing those books. I made a lot of assumptions based on my experiences of doing these kind of presentations and speaking at trading conferences back in the, in the early 80s. Like the first conference I spoke at was in 1984. And I spoke at, several years later. Even went on a world tour for Dow Jones in 1987. I literally went around the world for Dow Jones and Reuters out of a 36 city tour. I could have done all 36 cities. I didn't want to be gone that long, but I did 18 out of 36 cities and went all the way around the world. So, it's like I have this basic experience of the way people think about trading, but yet, like I said, I didn't write these books in a way that the novice trader could relate to. And it shocked me, literally shocked me, because The Disciplined Trader was published in 1990, and Trading in the Zone was published in 2000. And when the internet started getting big, and you had a lot of people doing chat rooms and all this sort of stuff, and people were recommending, that, hey, read Trading in the Zone, and a lot of the people that were reading it were just novice traders, because I'm getting this feedback and emails. It's like, whoa, this book wasn't meant for you. And I didn't even really know how you were relating to it. So I thought, you know what? I got to write another book, and I got to write it from the perspective, and I got to write it from the perspective of someone who really doesn't know anything about this business. The people in that room in Phoenix were people who basically had watched like a half-an-hour infomercial on how trading, how you can take financial control of your life by being a trader. Okay, you know, secure your retirement. Go into trading. Okay, with this particular methodology, you know, and you should be able to do it. Well, the reality of it is, a lot of these methodologies, people aren't lying to you about the fact that if you can actually follow the methodology, you can secure your financial future. The whole idea is being able to do it. Just like, for example, the very first workshop that I ever attended was in Bermuda, like I think in 1981, and at the time, it was being put on by three of, at that time, you know, people who were considered market gurus. And, you know, and at the very first morning of the conference, I mean, I'm really excited. You know, what am I going to learn? Oh, I just can't wait. And I, you know, I sit down in the room, and the speaker, you know, he gets going, and he's going for about 10 minutes. And someone in the audience raises their hand, and he stood up, and Jake, the speaker's name was Jake, and he stood up. As a matter of fact, it was Jake Bernstein. He's written a lot of books. You probably heard of him. Anyway, so Jake acknowledged the guy in the audience, and the guy stood up, and he said, and the speakers, of course, were going to talk about their trading systems and how people use them, that sort of thing. And the guy stood up, and he, in kind of an indignant tone that really surprised me, and I think it also surprised Jake. He said, "Jake, your system's so good, why are you selling it?" And, you know, I think the whole thing kind of took Jake by surprise, like I said. And Jake just stood there and thought for a second. And he said, you know what? I'll sell as many of them as you want to buy. Because out of all the 100 or so people in this room, there probably isn't one of you that could go back and execute it. Now, I'm sitting there listening to this, and I think, he didn't say this in a way that I thought he was kidding. You know, so, you know, I'm thinking, well, what's going on here? And nobody asked him to elaborate. So it's like, I'm just hoping this didn't apply to me. Okay, I'm just like, I don't know what he's saying. I don't know why he's saying it. I just hope it isn't me he's talking about. Okay, and it was, of course, it was definitely me, as well as everyone else in the room. So anyway, like I said, I really felt I had to write something from ground zero. In other words, if you don't know anything about this business, if you don't know anything about the nature of trading, and especially if you don't know anything about the nature of price movement, that you can actually go through, understand what you need to go through, and go through a process of changing the way that you think, because this is what this is all about, everybody. You're going to have to get used to the idea that if you're going to do this successfully, you are probably going to have to change some major assumptions, some major beliefs that you have about the nature of market trading to do it successfully. I'm not saying you're not going to have winning trades. I'm saying that if you want to create a consistently rising equity curve and assure yourself of an income, you're going to have to think differently than what you think right now. There's no way around it. Like, for example, most of you in this room, just quick example, most of you in this room would think that because I'm a trader and because I put on trades, I'm a risk taker. Does that make sense? Because we know that trading is risky, right? Come on, I'm going to have to get some feedback, guys, okay? You can't sit there stone-faced. You really can't. Seriously, you can, but it's going to make things hard for me. I don't want it to be hard for me. I want to enjoy myself, okay? So come on, just give me some feedback. Yes or no? Yes. Okay, thank you. Remember, I haven't done this in 3 years, so give me a break. I'm asking you nice. So, yeah, we're risk takers, right? And yet, when you think about it, everything that you do, or let's say I used to do as a trader with respect to analysis, was to try to eliminate the risk. Was to try to make the risk go away. Was to try to make sure that the trade I'm getting into right now, this trade, was going to be a winner. Not maybe a winner, but going to be a winner. Or why would I do it? Why would I get into a trade if I didn't think it was going to win? Does that make sense to everybody? Is that the kind of logic that makes sense? That's exactly the kind of logic that's going to make sure you're not going to be successful in this business. It's exactly the kind of logic that is going to assure you that you will not make it in this business. This business has nothing to do with winning on a trade-by-trade basis. On a trade-by-trade basis. What you're going to learn today is that your technical systems, okay, what they give you is an edge. Everyone, you heard the word probability said 100 times. Probabilities, edges. Edge is nothing more than a higher probability of one thing happening over another. There's a huge difference between understanding that concept and actually believing it in a way that you can execute your trades properly. You actually have to believe in the nature of probabilities at the very core of your trading personality. Which means you're going to have to give up on the idea that each individual trade is going to be successful. What your system does is give you an edge over a series of trades. where the outcome of each individual trade is unknown and unknowable. Not just unknown, unknowable. The more you think you got to know in this business, the less successful you're going to be. This isn't a business about knowing what's going to happen next. It's a business of getting your mind to the point where you're completely detached from your outcomes. Very different than the way we live our lives. Gino, I was talking to Gino last night. Gino's been an attorney for how many years? 43 years. What did you learn when you became a trader in relationship to the kind of strategies that you used as a trader?
Everything I use in law absolutely is completely the opposite in trade.
Did you hear what he said? Everything he used to be a successful lawyer is completely opposite of the strategies and the thinking methodologies that we have to use to be traders. If I'm a lawyer, am I detached from my outcome?
Oh, yeah.
You are? Yeah. If I'm a lawyer, am I detached from my outcome? Oh, no. If I'm a lawyer, am I detached from my outcome? Absolutely not. I'm going to make sure that I get the outcome I want. If I'm a doctor, am I detached from my outcome? If I'm an engineer, am I detached from my outcome? So if I'm saying to you to be successful in this business, you're going to have to become detached from your outcomes. Just how in the world are you going to get to the point where you can do that? You don't know. You're right. You probably don't. Thank you. Trade for somebody else. Not everybody, there the groups following, there are people that can trade for somebody else and be detached and trade for somebody else, and actually they're even more attached than what they would be normally. I work with both ways. There are people who can actually trade their own money. Once they learn the right methodology and the right mindset, they can trade their own money much easier than they can trade somebody else's. Because they're more concerned about, losing money for other people. Somebody you don't know? Yeah, it's still. There's a lot of variables in there. Yeah, that's, So basically, I had to write this book from, like I said, from the perspective of going from the ground up and having 2 books under my belt, which I thought were really tough books to write. I mean, they were very, very difficult books for me to write. And I'm thinking, and this is my own bias that I'm going into this whole project with. Like, okay, I wrote the Disciplined Trader. It took me 8 years. I wrote Trading in the Zone. It took me 5 years. Come on, I should be able to knock this out in a couple of years, right? Anybody, right? Should be able to knock this out in a couple of years? Yeah. 8 years and I'm still not done. Way harder than Trading in the Zone. Way over the top harder than Trading in the Zone or the Disciplined Trader. I can't even begin to tell you how difficult it's been and how challenging it's been for me. And how just the impact that it's had on my life even. It's just really been very, very difficult. But in any case, I found that breaking these concepts down to a core level where someone who doesn't know the business can understand it was not easy. And I made a lot, over the years, doing presentations, I've made a lot of assumptions. See, it's one thing to know how to trade, to break through the certain, what I call the threshold of consistency. Like if over here, this is like a mental threshold, okay? Like if you're down here and you're booming and busting, okay, your equity is, you go up, you go down, you go up, you go down, and you want an equity curve that looks like this, you're going to have to break through what I call the threshold of consistency. And this is a mindset. It has nothing to do with your methodology. I'd say nothing. But you're going to have a good edge. All I'm saying is that, but there are a lot of good edges out there, okay? But so this is a mindset. Breaking these concepts down in that way was just, I made a lot of assumptions. And breaking through my own assumptions was really a difficult process. Because what I was getting at is that it's one thing to learn how to trade for yourself. And however way you manage to break through this threshold of consistency, it's another to actually learn how to teach people how to do it. The process of doing it and teaching people how to do it are worlds apart. There's almost no connection. There's almost no connection at all. Because there are a lot of people who teach trading because they become successful traders, legitimately successful traders, and they teach it from their perspective without realizing that their audience is nowhere near their mindset and cannot do what they do. When I was, coaching in the early, the mid-80s to early 90s, I'm not going to mention names, but there were some, trading gurus out there that had huge followings and, brilliant people, very successsul traders, but absolutely did not know how to teach it, did not understand, where the common guy was coming from. And most of like my really serious suicidal clients were as a result of listening to these people. The ones that ended up, waking up in the gutter saying, oh my God, I'll do anything. Just because they didn't know how to teach it, that's all. And because the process of learning how to teach it is completely different than the process of learning how to do it. So like I said, I made assumptions. And those assumptions resulted in, making it really difficult for people reading The Disciplined Trader and Trading in the Zone to get what they needed out of it to break through this threshold of consistency. And I didn't really know that until, I got almost to the end of the book where, it's like the exercise in Trading in the Zone. When I finished that book in like 1999, it's like I thought I explained it. I really did. I thought I explained it. I'm going to apologize to you now, realizing that I didn't. I really didn't explain it, because in this new book, I've devoted 30 single-space typewritten pages to just the exercise. Because the big assumption that I made was that all the background, all the material that I wrote to as foundation to do the exercise, that somehow people would find a way to assimilate it and realize the connection on their own. And then when I started actually getting to the point where I had to write about the exercise, I realized that wasn't going to happen. And the reason why I know it didn't happen is because I would do presentations, and like for example in 2008, 2009, 2010, whatever, and because I did several for John in a row, where I did, like I said, 8, 9, 10, 11, and 12. Last one was in 2012. And so like in 2010, I go through the whole presentation, and explain what I felt people needed to get, and the exercise itself, but pretty much explained it within the context of Trading in the Zone. And then the next year, some people would, a lot of the same people, there's 100 people in the room, but there's a percentage of them that were there the year before. And I was like, how many of you did the exercise? Nobody. And not only that, I was wondering, okay, everyone in the audience pretty much, let's say the large percentage of people in the audience had read Trading in the Zone. And right off the bat, I'd say, okay, you've read Trading in the Zone. A lot of people said they'd read it multiple times. So I'm thinking, okay, how many did the exercise? Nobody. And it's like, so in 2011, we're going through this whole, this mystified me. Now, I was truly perplexed. I really was. I did not get it. I really didn't get it. And so in 2011, somebody in the audience just happened to say, after closing, getting to the point where the presentation is completed, there as much time as we had, and someone said, well, how many of us do you think are going to do the exercise? And I said, nobody. They were all taken back by that, because I was just flat out, none of you are going to do it. And then the next year in 2012, there were a few people that actually did it, and they got the results that they were looking for. Now, we're going to talk about this. We're going to talk about it in great length, mostly tomorrow. But it's like, I want you to leave understanding the process, understanding what it is that you have to do, and the process that you're going to have to go through to get to the point where you can acquire the kind of psychological skills. Because all the skills, there isn't anything about trading that's physical. What are you interacting with? You're interacting with information. There isn't anything physical other than just, if you've got the ability to use your mouse pad or use a mouse, you've got the eye-hand coordination to put your mouse in a certain spot on your trading platform, you got the skills down pat. You're golden on the skills, the physical skills. It's mental skills. It's how we interact with information, the state of mind that we're in. People don't realize that, that this is like to really do trading at a really high level, in what I call the subjective or the discretionary mode, as opposed to mechanical trading, where you've got a particular set of criteria that define your entry and exit, and it's rigid. So the market has to conform. The market has to conform to your rules, or you do nothing. Okay, I'm just going to give you a cursory explanation. In the mechanical mode, the market has to conform to your entry and exit rules, or you do nothing. There's nothing to do. There's nothing to think about. You're just supposed to enter when it says, put your stop where it says, put your objective where it says, and it either happens or it doesn't. Okay? In the subjective mode, basically discretionary mode, you can do whatever you want, whenever you want, based on whatever information you expose yourself to, and the way you want to combine that information in your brain to come up with an entry or exit signal, and where to put your stop and where to put your profit objective. To be in that mode and do it successfully, you better be in a real elevated state of mind. Because what you're going to find is that it's your attitude, it's a quality of your state of mind. Like, are you confident? Are you fearful? Are you in a carefree state of mind? Are you agitated? Are you angry? You feel like, do you feel like getting revenge? If you're going through personal emotional trauma, if someone said, if someone you knew was trading, was a full-time trader, and they're going through a real traumatic experience in their life, would you advise them not to trade? Makes sense, right? Just makes sense. And yet what people don't realize is that there are degrees of states of mind. In other words, you've got on a continuum. At one end, you've got positive, you've got confidence. Okay, you got confidence, and here you got fear. And there are degrees of confidence and fear. And until you become aware of where you're at on that continuum, you have to adjust the way you trade based on your awareness of where your state of mind is. Because your results are going to reflect that. The way you pick, what information you pick or you choose to utilize, and where your trade location, your size, your stop, your objective, all going to be reflected in your state of mind. It would be. I'll give you an example. We had just had the NCAA, college basketball championship, right? Okay. Now if I said that at a professional or even a college level that some of these kids or some of these guys, they can hit 25 or 50 free throws in a row, would anybody dispute that? That they practice thousands of shots and they get at the free throw line while they're in practice and hit 25 in a row, 30 in a row. There are people who can do that. So if you can do that, you have got your muscle memory in place. Your muscles are chained to the foot, like as if you're like there's these little memory cells in each of our muscles. It's like they're completely in place so that you know that when you step, all the physical variables are exactly the same, no matter where you're doing it. The foul line is right here. The basket's so many feet away. The basket's a certain height. The rim is a certain diameter. That's it. All the variables are the same. Now, put one of these kids who can do 25 in a row in a situation where there's about 2 seconds left in the game. The national championship's on the line. And with 2 shots, he can win the game. With 1 shot, he can tie. 2 shots, he can win the game for himself, his college, all the fans, and his team. 1 shot, he ties. What is going to be the determining factor is whether or not he wins that game? Well, when you say control that fear, you might not have any fear. All I'm saying, what's going to be, just at a general level, what's going to be the determining factor? What? Mental, his state of mind. Yeah, his state of mind. Why do you think, everyone knows, like for example, field goal kickers who are in a position where they can kick a field goal and win the game, the opposing coach calls a timeout. They put them on ice. Okay, everyone knows. But what does putting them on ice mean? It means, you know what? These guys are pros. You give them the opportunity to get up to that tee and kick the ball without thinking. Their muscle memory is going to come into play, and it's going to be automatic. Now give the guy the opportunity to start rolling some negative thoughts through his brain, and he might choke. Same thing with the kid on the foul line. If he can keep his thoughts positively focused on the process of doing what he needs to do, he'll probably make both shots. If he starts thinking how his life's going to go to shit, complete and absolute shit, if he misses those shots, chances are he's going to miss them. If some thoughts start rolling through his brain about coaches who have berated him, parents who have berated him throughout his life, and being in these kinds of situations, chances are he's going to miss those shots and choke. And this will go right along here. Here we had just normal confidence, and there's what's called a threshold of euphoria. Okay? You can cross from normal confidence into a threshold of euphoria, which is just as bad as being in a state of fear for a trader. But same way with this kid. Let's say he's standing at the foul line, and he's starting to think about what a hero he's going to be in a couple of seconds. And he starts celebrating in his brain before he actually takes the shots. That extra degree of excitement just might have enough of an impact on the way the ball leaves his fingers for him to miss the shots. So it can't be too much. It can't be fearful. He just has to have the right amount of confidence flowing through his brain and the right amount, and be focused in just the right way before the ball leaves his fingers. And he'll make the shot because the muscle memory is there. Anybody have a problem with this? When we're trading in the discretionary mode, these are the things we've got to be aware of. We're interacting with information. It's like the analogy would be the kid's muscle memory to shoot the free throw would be our memory of all the different patterns we've learned about how to define an edge. The patterns are in our brain. We can identify them when we see them in the market. How we utilize those patterns are going to be a function of the state of mind that we're in. Now, you don't have to get to that level of awareness to be a successful trader if you stay in the mechanical mode. In other words, once you learn how to identify an edge, you learn how to think in probabilities, you get rid of what I'm going to just refer to as the 4 primary trading fears: the fear of being wrong, the fear of losing money, the fear of missing out, the fear of leaving money on the table. When you've neutralized those 4 fears and you can trade in a carefree state of mind, carefree, detached state of mind, you can stay in the mechanical mode for your whole trading career. And don't really have to address a lot of these state of mind issues. Not that they won't come into play, Not that they won't come into play, because they will. If they're there, they will. But at least in the mechanical mode, you know exactly what you need to do and when you need to do it. So any thought of deviating from that, you know there's a problem. I'm going to get some perplexed look on it. I'm going to go into all the detail. I'm just giving you an overview here, okay? So don't get too perplexed. Go ahead. Oh yeah, the fear of being wrong, the fear of losing, missing out, leaving money on the table. So you don't have to reach that level of awareness, that, let's say, heightened level of awareness to be able to be successful. But you better be at that heightened level of awareness if you don't want to create disastrous results in the subjective mode. Most people are trading outside their skill level, meaning they should be trading mechanically, and they're trading subjectively. They're trading in the discretionary mode, and they have nowhere near the skills to be able to do it. Because in that mode, you can do whatever you want. See, in the mechanical mode, I would say you wouldn't even to think about pulling a stop, even to think about moving a stop is a trading error. In the subjective discretionary mode, you want to move a stop, move it. You want to pull a stop, pull it. Because the assumption is you're not doing it from a state of fear. You're not doing it because of what you're afraid of the results are. You're doing it because that's what the market's telling you to do in this moment, based on your ability to read the market from an objective perspective. Because every mistake, just about every mistake that you can make as a trader, will be the result of, I'm afraid of being wrong, I'm afraid of losing money, I'm afraid of missing out, I'm afraid of leaving money on the table. You're going to get in too soon, you're going to get in too late, you're not going to define your risk because you're thinking, hey, why define the risk? I know we can get in this trade, and I think it's going to be a winner, so there is no risk. Yeah, oh, okay, yeah. Or you say, you read all the books and you go to the conferences and say, hey, don't do this without determining what your risk is before you get into a trade. And so you think, okay, well, I've got to, everyone says I got to do it, so I'll do it. So basically, it's lip service. Lip service in the sense that, okay, you'll put a stop in the market, and that's where usually people use percentage stops as opposed to what I call structure stops. Structure stops are where you're actually reading the market in a way where, where's the best place from a structure perspective that tells you this trade isn't working, or the likelihood of it working is so diminished in relationship to the profit objective, it's not worth staying in anymore. Did you guys get what I just said? Okay, that's a structure stop. When you pick an arbitrary percentage stop, like 1 or 2%, that's people that do that usually that's risk. That's lip service risk management. They really don't believe they're going to get stopped out, but they've been told over and over again, you got to do something like that, and so they put their percentage stop in the market and thinking, well, it's never going to get hit anyway. And of course, when it starts to look like it's going to get hit, they'll either pull it and put it somewhere else, or if they're coming out of a state of basically pain where they've lost 3 or 4 trades in a row, if it starts even getting close, they'll pull it thinking, you know what, I'm going to save myself some money. Nobody in this room done that? Oh, okay. Yeah. Today, yeah, right. It could be anything, yes. A structure stop could be, the question is a structure stop like a 2-bar stop? A structure stop is based on your definition of an edge. We have edges for getting in, we have edges for getting out. Whether the edge is defined as a profit objective or a place where the market's telling us that the likelihood of this trade not working is so great, it's not worth spending any more money on. Or not worth, in other words, the likelihood of it even hitting the profit objective is so diminished that it's not worth spending any more money on. Go ahead. No, not in this business. Zero fear. Absolutely zero fear. Absolutely zero fear. I want to be emphatic about that. No, there is no, absolutely zero fear. You have got to trust, this is a good question, thank you very much. You have got to trust yourself, because what you're going to find when I get into this example is that fear acts on our perception of information in a way that we actually create the very experience we're trying to avoid. Okay, I'm going to explain how that works. But fear will act on our perception of information, how we perceive it, the way we filter the information, and how we behave in a way where we will actually create the very experience we're trying to avoid. So if I'm trying to avoid being wrong, that's exactly what I'm going to end up doing. I'm going to act and see things in a way that create a situation where I end up being wrong. If I'm afraid of losing money, that's exactly what I'm going to create for myself. Zero fear. Not only that, you have to, because fear and trust are opposite of each other. You've got to be able to trust yourself. You have to be able to completely and absolutely trust yourself that you can act in your own best interest and do the right thing without experiencing pain first. How can you be successful in this business if you have to experience pain to get out of a losing trade? That if it takes that much, in other words, the market has to go so far against us that we can't stand it anymore, that we eventually get out. Go ahead. No anxiety, no fear, no, completely carefree state of mind. You're going to have to get to the point where you're in a completely objective, carefree state of mind. You cannot care about the outcome. Remember I started, it wasn't even that long ago. It's detached from the outcome. You got to get your expectations in line with the reality of the environment you are operating in. You are operating in a probabilistic environment. That really means, not lip service, that really means probabilistic. Maybe I'm going to get the outcome that my edge says or my edge is predicting will happen. Maybe. I'm going to prove this to you. He said, one of the reasons why I wrote this third book is because I came to the realization that my personal experiences as a trader starting out, because I started trading in 1978. So my personal experience as a trader and then going to work for Merrill Lynch at the Chicago Board of Trade as a retail broker, it's like I ended up learning things about how the market works that ordinarily, without being on the inside of the industry, people just wouldn't get. So I also took that for granted. And what people don't get is when they don't understand order flow, when they don't really understand the nature of order flow and how prices move from an order flow perspective, it's very hard to learn how to think. It'd be very hard to, let's say, extrapolate what, watching prices move on a screen in a way where you could think, well, I need to think like this, I need to think like this. So when you don't understand order flow, that really screws you up. Because when you really do, everything that I'm saying will become self-evident. When you understand order flow, all the things that I'm saying will just yeah, okay, yeah, that makes sense. So if I say to you that if you operate, you've got to get your expectations in line with the reality of the environment that you're operating in, it means you don't know what your outcomes are going to be. There's no way you can know what your outcomes are going to be. I'm also going to say that you don't also know why you're winning or losing. When you understand order flow, you will know that there is no way that you can know why you're winning or losing or even find out. Think about that one for a second. You don't know why you're winning or losing, and there's no way to find out. Do you understand how prices move to the extent where you can think to yourself, yeah, okay, that makes sense to me. I'm going to explain it to you, but does it make sense now? And the implications of what I just said is that every prediction your methodology makes, in essence, is a guess. And if it's a guess, the implications are, guess what? You're gambling. What's that? If you're guessing, you're gambling. That is the reality of our situation. We have no assured outcomes, and we cannot make a connection between the reasons why we put on a trade and the reasons why the market went in our favor or went against us. If we can't make that connection, then we don't know why we're winning or losing, and it isn't any different than sitting down at a blackjack table or playing a slot machine, because there's no way to know. We are gambling. Regardless of the fact that you're using analysis, regardless of how good your analysis is, I don't care how sophisticated it is, there is no analysis that can take the gambling element out of trading. Listen to me. There is no analysis that can take the gambling element out of trading. There is no analysis that can eliminate the risk. There is no analysis that can assure us that this trade is going to be a winner. When you understand order flow, you will agree with what I'm saying. And then you'll start thinking about this whole thing differently. So instead of trying to avoid the risk, instead of trying to use your analysis to avoid the unavoidable, to do the impossible, you will accept the risk and understand it from a probabilistic perspective, and then everything will change. Everything will change. You'll even see a different market. You'll see the same bars, but you'll be interpreting it in a way where it's like, oh yeah, okay, that makes sense. Yeah. It's like, one second. It's like, we're here in Las Vegas. How to casino. You heard John say, or somebody, maybe yesterday, or I think somebody said, about even trading in zone. It's like, be the casino. Well, here's what this means. Like, casinos know that they have the law of probabilities working in their favor. The law of probabilities is like magic. See, the casinos really aren't gambling. Because they are gambling in one sense and gambling from one perspective, but not in another. On an event-by-event basis, this blackjack hand, this blackjack hand, this blackjack, every individual hand that's dealt, they don't know the outcome to, and in essence, they are gambling on the outcome of each individual hand. But since they have the law of probabilities working in their favor, what that means is that over a large series of events, they will always come out net winners. So in essence, they're not gambling. We can do the same thing as traders. Exact same thing. We have an edge. Our edge gives us a higher probability of one thing happening over another over a series of trades. But each individual trade, the outcome is not known nor knowable. All I have to do is execute that edge flawlessly every time, and I will come out a net winner. And in essence, over a series of trades, I'm not gambling. On each individual trade, I am. Are you guys with me on this? I'll explain it in more detail later on. There is nothing you can do to take away the risk. Burn that in your brain. There's nothing you can do to take away the risk. Any effort that you put towards taking away the risk is going to assure you of failing. To whatever degree you're going to try to take away the risk of being wrong, the risk of losing money, the risk of leaving money on the table, the risk of missing out, all these four fears will detract from your ability to create a consistently rising equity curve and cause you to make mistakes. Okay, go ahead. Who had a question back there? Go ahead. Well, I don't know how you define a good poker player. I'd have to know how you define I don't know how you define a good poker player, so it'd be hard for me to answer that question. What's that? Well, yeah. See, winning one night, or and getting on a winning streak is different than someone who can gamble and make a consistent income. People who can make consistent income gambling, work basically off the same kind of mindset. And they also there's a lot of other variables involved. It's like people who are immersed in gambling. I mean, there's a lot of dynamics in play that are not so much different from a psychological perspective. But for an example, and I don't gamble. I mean, I don't play blackjack anymore or anything else like that. But anyway, it's like if I were, what I would do, the first thing I would do is I'd walk through a casino and I try to find a dealer who's having a bad night. In other words, a dealer who's busting on a consistent basis. Or if I was playing craps, I would peruse the tables until I found somebody who was hot with the dice. Because I do believe in streaks. I believe in winning and losing streaks. And if you can, and if I'm playing my cards right, if I've got a basic strategy on how I'm going to play my cards, or how I'm going to bet at craps, what I'm going to want to do is I'm going to want to, find somebody who's already on a streak or looks like they're going to be on a streak. In what way? If we could flip the coin 1,000 times in a row, okay, we would come up with a pattern, a discernible pattern where there would be very little difference between heads and tails if the coin is evenly weighted. Right? This is a pattern that would come up over and over and over again. You could actually bet on it. You could actually bet on the fact that if I flip the coin enough times, like a thousand flips, that the relationship between heads and tails would be within 1%. Right? Let's see, but within that 1,000 flip sequence, can you have winning? Could heads come up 10 times in a row?
Yes.
Yeah. Okay. I didn't say it was predictive. What I'm saying is I'm just looking for people. I'm looking for situations where it's likely that this is if someone's on a winning streak, they're on a winning streak. I don't know how long it's going to last.
Or why?
Or why? I don't care. I'm looking for edges. That's all I'm saying. So to answer his question about gambling, it's not a good correlation because there's too many other factors involved. So, but otherwise, I'm just looking for that kind of edge. Go ahead. Yeah, I will now, but the whole rest of the time is going to be pretty much elaborating on it. When I say be comfortable, you say be comfortable. I say that you accept the risk at such a core level of your trading personality, of your trading belief system, that there is no other part of your mental environment that would argue for anything different. In other words, what I mean is that when you've accepted that I can put this trade on, I do not know what the outcome is going to be. I don't care what the outcome is going to be because I've adopted a series of trades perspective, meaning that I don't know. Basically, what am I expecting? I'm expecting wins and losses over a series of trades. And I don't know the sequence of wins and losses. But I do know that my edge in the past has produced, let's say, a 60% win-loss ratio or a 70% win-loss ratio. Again, I don't know what the sequence to wins and losses are. And I don't care. I just need to execute properly. And when I get to the point where I really have accepted these principles, accepted them at the very core of my being, I will be able to do this without fear. I'm going to show you how to do it tomorrow. But what I'm saying is that this is where we're getting to. We're getting to the point where if you're going to do this right, you gotta transcend your fears. And to transcend your fears, you're going to have to learn how to think differently. It's that simple. If you're not willing to learn how to think differently, you might as well walk out of the room now. It's not going to happen for you. It really isn't. Go ahead. And there's enough back case of people who have been in this business for years, who have lost one or more fortunes, until they get to the point where they come to the realization that, you know what, my life strategies don't work in this business. Why do you think there's this theme in all really good traders, this theme that most of them had lost one or more fortunes before they finally broke through the threshold of being able to create consistent results? Because that's what it took. It took losing all that money to break down the resistance of their dysfunctional beliefs about the nature of this business or their erroneous assumptions about what this is about. And most of those erroneous assumptions have to do with analysis. Which is normal, because when you think about the way we define analysis in our normal everyday life, if I step into and engage in an analytical process, and I really believe that process has validity, then when I come to a conclusion, I should think that I'm going to get the outcome I expect. Wrong in trading. That's not the case. You don't open up a trading account at a brokerage firm and they tell you that, you know what, whatever you think, the way you define analysis doesn't work here, does not work. You're only using analysis to get an edge. And an edge is a higher probability of one thing happening over another. And if there's no way to assure myself that this trade I'm going to get into is a winner, I'm guessing. And if I'm guessing, I'm gambling. They tell you that? Anybody ever tell you that?
John.
Yeah. Okay. John's a good guy. Okay. I'm sorry. Yeah.
So go ahead and get involved in contracting something because of the pace of all the things that reduces your risk. That's part of your strategy. You're not eliminating risk.
No, you're not. No. You're never eliminating the risk.
Right.
You're accepting it. You're never eliminating it. There's nothing. Just you have to get to the point where you're just, like I said, there's no question in your mind that the risk always exists. Now, when you say eliminating risk by scaling out but see, there's a difference between what you say is reducing risk from a money management perspective and actually accepting the risk. When you reduce risk from a money management perspective, it's because the market's telling you, one, that's your strategy, okay, and two, the market's saying this is a good place to take some profits. That has nothing to do, you can say, the vernacular is, you can say, yes, I'm reducing risk, but that's not what I'm talking about. I'm talking about from a psychological perspective, actually accepting the risk, okay? So there's a difference, but these are subtle differences, and these are the kind of thing that gets us in trouble. See, when we don't understand these subtleties, we can get into a lot of trouble. Go ahead. Do I what? No, I really know what the squeeze is. So I have been trading a long time. As a matter of fact, I use TradeStation. I turned my trading platform off really just about 3 years ago, right around this time, thinking that, you know what, I don't want to be distracted with the market. I'm going to be done in 3 months. Yeah, I'm still not done. And I haven't turned it back on. So I don't even watch the markets right now anyway. Yeah, as a matter of just to tell you what, maybe I shouldn't say. I don't know. I'm gonna say it anyway. I'll give you an example of what I'm talking about. Where I'm at right now in the book is the last chapter, and I'm actually writing about subjective discretionary trading. It's taken me like 26, 27 days just to get the first 3 paragraphs. What's the name? I know you're gonna ask. I've got about 20 names. When I'm done, I'll pick one. Okay. When the name comes, I write it down, and if I can find the file, because I haven't thought of the name in a long time, I'm going to have to find the file, because it's like thousands of files. But anyway, it's like, and when I say I worked, it's not like I haven't been writing. I've got pages and pages and pages. It's just that the words have to come together in just the right way for people to really get it. And it's not till it resonates, it resonates with me that, okay, I got the sequence of the words just right. And like I said, the 25, 26 days just to get 3 paragraphs. And if you had asked me a month ago, I'd have said, hey, I'm almost done with it. I'll be done in a few days. Man. And what really scares me is the next part is intuitive. Now, I've already got a lot of the stuff on intuitive written, so all I got to do is find it. But then again, no, seriously, I'm not kidding, because I've written it years ago. So, I'm going to have to find what I've written. I'll find it. It's not like it's lost, but, I don't want to get into it. Anyway, so where are we? Yeah, right. No, exactly. It's my own problems with the whole writing process that, creates all the difficulty when you get right down to it. I didn't grow up to be with the aspiration of being a writer. You really? Or an author? Or have any idea what that was like? Or here I'm almost finished my 3rd book, spent most of my adult life writing books, and I'm like, it's like, I just wanted to be a professional hockey player. I'm not kidding you. I'm really not. I grew up in the 60s or in the 50s, because I'm 66 years old, so it's like I grew up in the 50s, and back then there were only 6 NHL teams, and there weren't any American hockey players in the NHL. There wasn't not one American hockey player in the NHL. So my chance of becoming a professional hockey player was 0. But all I'm saying is that my aspirations were to be a professional hockey player. That's what. And to be a writer, it's like, come on. I used to. This honestly got true. When the term, I went to Michigan State, and the term would start, And I go into a class, and the professor said, we're going to have a term paper. I'm out. Go my advisor, drop the class. Writing, forget it. I avoided writing at all costs. Now I know why. My life purpose was to be devoted as a writer, and I was just avoiding what I was going to end up doing. I didn't. Why start it back? Why start it when I'm in my late teens and early 20s? I'm going to end up spending my whole life doing it. But anyway, go ahead. You know what? These are all personal, individual variables, and it could be anything. I mean, just even, is John here? John. Okay, we were talking last night, in the cocktail thing, and John brought up that he made a connection. You want the connection about being a hero?
So it was interesting last night. We were talking, and as I was going through this kind of it's always a lot of fun to living, disasters in your life. And
really, yeah. When you're on the other side of it, yeah. When you're on the other side of it, yeah.
And as I was talking about it, it was a great time where consistently taking like early 20s, taking like $10,000 and budgeted up to 100 to 130. And I've talked about this before, right? In one smart way, right? I get to 130, I would take $30,000 and go buy some real estate. And then the logical explanation in my mind was, well, I'm going to take 10 and turn it into 100, so now I'm going to take 100 and turn it into a million. See? I mean, so think logical. And the first time I did that, it was like 6 weeks later, I was back to 10. I don't really know what happened. And then it's like, okay, so I, took it off. About a year and a half later, I was back up to 120, 130. Again, in one start thing, took that down back to 100, took that money for real estate, down payment 100 questions, stuff like that. And then I'm like, all right, so obviously the market got me at other times. So now, I took it from 10 to 100, and now, I was working and going to school. And, okay, so now I'm going to go from 100 to a million. And in my mind, this million was like a big thing. It's like, well, that's financial freedom. I can quit my job. That's all I do. 6 months later, I'm back in. It's like, man, the market got me again, right? And so the third time was the worst. Was the, at this point, it was like a good-sized trading account, about $130,000, $140,000. I was pulling weekly income out of it. I had a job, I think it was like $30,000 a year. I was ready to quit. My wife and I moved up at the time, because we moved up to Minnesota in January with the job transfer. It was 30-0, and she said, look, you're great, all, but we don't have food and stuff. The car was parked outside, but we don't get a garage and a house. And I was like, okay. So found a house, $30,000 down payment, and I had to figure out my trading account to do it. And I really had this in my mind, but I was kind of like, I really like my trading account balance, and I don't want to use it by $30,000. So I was going to go to trades, made $30,000. And then when I pulled up and out my trading account balance, did the same. And so that was kind of the same idea. And so I did that, and it was like, this trade I didn't etch in my mind because I bought 100 Forex puts at like $8, so $8,000. And this was like in 1995, nice downtrend in the market there. And then at one point the premium dropped, and toward the end of the day, and it came down to like $30. And I was like, wow, I might have been an 8, I love them at 7. So we had to put the rest of the account at 7. And remember, I was trying to make $30,000 and then it closed. I was up like 7 or 8 times. Like, wow, you're looking at that morning, I was doing nothing. So the next morning I wake up, I turn on the ABC, or a single apartment, and there's a green arrow, and it's 136 down points up. So, naturally I turned off the TV, which is going to honestly, that's not a live shot, it's a live shot. And turn back on down, 136 points. I'm like, okay. Now at this point, I've been trading long enough to know, like, okay, so this obviously is trading for work. When we come back down to half a gap fill, which is a high probability, I'm going to get out of our trade, I'm going to end up losing that trade. I'm like, lesson learned, I would never ever do that again. So now I've got to trade it sideways, but I've never seen such a sideways market. And at the end of the day, it was, wrong way. And the next morning it got up and rallied, the next morning it got up and rallied. And I've never blacked out in my life, but I don't remember that period of time after that. There were like 4 days. And I woke up suddenly and realized the next day was the closing of the house. I'm like, I have to sell it. Put it in my account. And I sold it, and my account was like $140,000. Remember, I paid $30,000 off the house, $70,000. So, okay, so this is and at the time, it was just very clear to me that, I did not go tell Maria what happened. So I maxed out my credit cards, got money, went to closing, the money in the account. Everything was going fine, but at the last minute, the lady was technical people said, we said Then you're going to put $30,000 out of your investment account. But it came from your checking account. We just need to see the buyer from your
jeez.
So at that point, I just decided that let's close it back. This is stupid. And I said, I don't want to do it. So we went back and forth for 30 minutes. I'm like, I don't understand what you're saying. Finally, I got frustrated. And somebody's like, tell me how that happened today.
Wow. Worse than I thought. But you know what I want you to get to, though? Was applying. Okay, yeah.
So after this, I'm having like a really hard time with this. I'm going like, I really want to make a living, like not do this. I need to find out what's going on. That was not a just a trader. And as I was reading it, I mean, it was just kind of like going, wow, this is what was right for me. And what I realized out of it, and this is, over the course of looking over it, is that there was something naturally heroic in being able to survive that. And somehow I firmly believe that subconsciously creating situations where I can do it. And how heroic is it to lose every penny of capital that you have and still able to buy a house? Right? There's no bullshit in that. And at the time, that obviously wasn't going through my mind at the time, but looking back at it. And another line, it's like one of those, okay, you kind of grow up, and everybody kind of has issues like, okay, parents divorce, okay, dad was good. The things that maybe I wish I could have done something to help out. And I was replaying it out of my trade. So, but once I realized that, it stopped happening. So that's one of those things where it's kind of hard to it's one of those things that's hard, it's hard to point at, yes, that's what happened, but I'm like, once I realized it stopped happening.
Yeah, thank you. That's exactly what I wanted. He was applying his own agenda. In other words, he had another agenda other than just being a successful trader. So that's why I couldn't answer your question about, what's happening with people because there's all kinds of agendas that we have. And when we trade in mechanical mode, it's at least a lot easier to be successful because we know exactly what we need to do, when we need to do it. Any deviation, we're making a trading error. In the discretionary mode, there's no such thing as a trading error because you can do anything you want. But then what you have is you have all these personal agendas that can really start to assert themselves. You can have personal agendas asserting themselves when you're in mechanical mode, but again, at least you know something is going on because I'm not executing properly. I want to make I'm about ready to do something that is defined explicitly as an error. And so at least if you got enough presence of mind to say, you know what, I'm going to step through that compulsive behavior and do what I need to do anyway, you'll be all right. But when you're in the discretionary mode, these agendas can assert themselves in a way that, unless you have a really high level of awareness, you don't even know what's going on. Making sense? Okay, that was the introduction. As a matter of fact, you know what? Before we get going again, why don't we take a 5-minute break, a bathroom break? Is that all right? Everyone with again? Okay. What I want to get into now is to start building a foundation for understanding that not only do we not know what's going to happen next, there's no way to know. Literally, there's no way to know. It doesn't seem the industry isn't set up that way. The industry is not set up that way to allow you to think that there's no way to know. But I'm going to prove to you that there isn't. There isn't a way to know. And the problem, and the thing is, when you really grasp why you can't know, then you won't think that there's some way to eliminate or reduce the risk. Because if I go into a trade, if I do my analysis, I stepped into this analytical process, and I come to a conclusion. My analysis makes a prediction. I put on a trade. The trade works. Is it not going to be natural for me to think that the market is moving in my favor for the same reasons I put on the trade? For the basic screen-based trader like we are, okay? I'm not talking professionals, I'm not talking fund managers or whatever. For the typical screen-based trader, that is almost never the case. There's almost never a relationship between the reason why you put on the trade and why the market went in your favor. And even if there was a relationship or correlation, there isn't any way for you to find out or prove it. Zero. That means that you don't ever know if your analysis is ever right. It'll be right in terms of, you'll know if it's right if it made the right prediction. You won't know if you had the right reasons for making the prediction. And if you don't know that you had the right reasons, then there's really nothing to be right or wrong about. Because one of the primary fears of trading is I'm afraid of being wrong. Hello, there's nothing to be wrong about because you don't ever know if you're ever right. See, when you start understanding the nature of this business and the way it really works, you'll start shifting your perspective and say, you know what, there's nothing to be afraid of here. I can't prove if the reason why the market moved in my favor was the same reason why I put on the trade. And see, the problem is, as soon as I think that I know the reasons why the market moved in my favor, I will just naturally assume I can duplicate the process. It'll seem as if I'm in this winning trade. I know why I put the trade on. I'm assuming that the market's moving in my favor for that same reason, allowing me to think that I knew what was going to happen. And if I knew what was going to happen, then guess what? I've eliminated the risk. That is the most dangerous thought you can think as a trader. Is thinking you've eliminated the risk. The worst case scenario in thinking that we've eliminated the risk is a condition called mind freeze. Does everybody know what I mean by mind freeze? You think you know what's going to happen. You've got 3 or 4 winning trades in a row, and it's like, hey, I get the next signal. I got this, I got the market by the balls. Okay, I'm going to load up on this one. So instead of being, 100 share trader, you move to 1,000 shares or 5,000 shares or 10,000 shares or whatever. So as you make this money management error, in other words, you are now stepping into the realm of trading far more than what your account size would say is prudent. All the market has to do is go against you just a little bit. Just a little bit. And because we're so, in other words, our level of commitment based on our trade size would be corresponding or correlated to how convinced we are that the market's going to go in our favor. So that just that little bit against us, and we go into a state of mind freeze. In other words, our expectations of what's going to happen are so far away from the reality of the situation that our minds cannot process the experience appropriately. It shuts down. And as a result, we sit there and watch the market take our money away as the market moves against our position until like an innate sense of self-preservation kicks in. But that level is different for everybody. That level of self-preservation, where our minds kick in, that self-preservation mode, where it kicks in is going to be different for everybody. And we just like snap out of it and get out of the trade. Or like to say we're losing $1 more. Losing $1 more is 1 degree more painful than admitting that we're wrong. Okay? In other words, everyone has life experiences, memories that fall into a general category of what it means to be wrong. Like this is these would be negatively charged beliefs. All the ways that we can be wrong in our lives. That if we have experiences that tap us into this pain, we will experience it. All the beliefs and all the experiences that we have that go into our memories, just in a general category of what it means to lose, this is all negatively charged, painful, emotional energy. When the market takes away, in other words, it is more painful to lose $1 more than it is to admit that we're wrong, is when we'll get out of that trade. This is not a good way to trade, people. This is not going to assure you of success. Again, like I said a little earlier, we have to trust ourselves. We cannot be. Most people never recover. The traders that I've worked with, I would say that for the most part, most people never recover from it. They can if they really want to work at it. I'm not saying they can't recover from it. I'm saying that they don't want to do the work. They don't want to process. They don't want to go step into the process of what it requires to do the work to recover from a mind freeze experience. I'm not saying they don't keep on trading, but they're so damaged that, because mostly when people experience a mind freeze experience, understanding the underlying dynamics of what caused it and what caused that pain, what do you think they think their way out of it is? How do you think they're going to compensate for it? More analysis. And then, of course, the more analysis, the more possibility of analysis paralysis. And the next thing you know, people spend years, learning how to read the market. They become absolutely excellent analysts. They really do. But they can't put on trade because there's just too many variables to consider. And one of those variables that I might have overlooked is the one that's going to cause me to lose. And so, therefore, I can't get past the fear and put on trade. So, Okay, so what we're going to do is, what I'm going to do is basically give you some. This is sort of a little bit of evolution of how I came to the point where I recognized that we don't know what's going to happen next, and the risk always exists. And these are some of the things like these experiences that initially happened in my life that I really kind of just that I took for granted. That I don't you really don't need to know. And not only that, there's no way to know. When you understand order flow, there's no way to know. Well, maybe I should give you order flow first. We'll see. Let's just try this. Okay, how do prices move? Prices move is a function simply of an imbalance between the buy and sell orders flowing into the pit or flowing into the exchange. It's that simple. When there's an imbalance between the number of buy orders flowing into the exchange and the number of sell orders that flow into the exchange. So, for example, if we have 10, 11, 12, 9, 8, 7, and the last price is 9. What we have is we have traders who are bidding at 8 and offering at 10. Now you really have to there's a couple of things to take into consideration. One, there is as speculators. And interesting how we know that we're speculating on price movement and yet do not think of ourselves as gambling, and yet we will define ourselves as speculators. Well, we're speculators who don't gamble, okay? We're speculating, but we don't gamble. Okay. Anyway, what we have is a situation where we need price movement to make money. The price has to move for us to make money. It's that simple. Whereas, for example, there are several market participants who don't want the price to move. These are people who use the markets for legitimate commercial purposes. These are your hedgers. These are people who are naturally long or naturally short, whatever it is that they do for a living. So, for example, if I'm a farmer and I'm planting my corn in the spring, anticipating harvesting it in the fall, think about this, the moment I decide to plant my corn and how many acres I'm going to plant and what I anticipate my yield to be for those acres, I am long corn. I am long the corn market. All I did was decide to plant the corn, and I become long the corn market. Why? Because whatever price fluctuation occurs between the moment I decide it and the moment I harvest my crop is going to determine how much money I get. So if I get a million bushels or 100,000 bushels, whatever the price of corn is when I harvest it is what my income is going to be. So as a farmer, I'm thinking, okay, my cost of production is X number of dollars per bushel. The price of corn, let's say the price of corn is at $7 a bushel right now in April. I don't know what it's going to be in October or November. I have the slightest idea what it's going to be. I'd like it to be $10 a bushel or $9 a bushel, but I don't know. And what I say, $8 a bushel start out with, and 7, let's say 8. And $8 a bushel, you know what? And my cost of production is, let's say $5 a bushel. Would I be satisfied with a $3 a bushel profit? Yeah, I think I would. So what am I going to do? I'm going to go into the futures market and sell the equivalent amount of futures contracts. I'm selling my crop in advance. So if I'm anticipating, let's say, 100,000 bushels, and one futures contract is 5,000 bushels, what am I going to do? I'm going to sell 20 contracts. If I think I'm going to get 1 million bushels, what am I going to do? I'm going to sell 200 contracts. And what I have done is I've locked in my price at $8 a bushel. If my price is $8 a bushel, I've locked it in at $8. My cost of production is $3, or my cost of production is $5. That means I've locked in my profit at $3 a bushel, no matter what the price is in October. But in essence, it doesn't matter what the price is in October because I've got my price already. So the price can change as much as it wants. But what a lot of speculators, people who don't understand the markets don't realize is that when hedgers enter a market, in other words, what I'm going to show you is that it's an imbalance between the number of buy orders and sell orders that flow into the pit to determine whether the price moves up or down. And because we might only be trading, 5 or 10 mini S&Ps, or even as big traders, we might get into, in terms of shares of stock, might get into a pretty significant amount of shares. People don't realize is that there are commercial and institutional entities that can put on orders, massive orders, that can affect the price, affect the imbalance between the buys and the number of sells coming into the pit, and think that they're taking risk, that they can't. Nobody would do that because it's too risky to do it. Wrong. It's not risky. They're eliminating the risk. They're putting in orders that can have a huge impact on the price, and they're eliminating the risk because they're already naturally long or short. You guys, you sort of with me on this? So, for example, if I got an electric motor manufacturer, and my sales manager comes back with a huge order that he sold these huge generators that are $500,000 a piece or whatever, and he went over some foreign country and sold 10 of them or something. The moment he signed the contract, the moment he got the purchase order, whatever the amount of pounds that it takes to make these of copper that it takes to make these orders, they are short copper unless they already have it in their inventory. Chances are they don't have it in their inventory because, let's say, they're running at high capacity, and what they have in their inventory is just enough to make the orders that they already have. And because they're not even going to start making the orders for 6 months from now or whatever, it's like they don't want to acquire the actual physical inventory of all that copper. What are they going to do? They're going to go into the futures market and buy the equivalent number of copper contracts that they need to lock in the price of copper when they need it to use it, so that they can guarantee their profit margin. That might be a huge order. Now, if I just happen to be trading off a moving average, my technical indicator off a moving average on in copper at the time that order hits the pit or hits the exchange, if I'm on the long side, if my moving average just shows me about 2 or 3 minutes before their huge order hits the exchange, I'm going to find myself in a winning trade. Did my reason for putting on that trade have anything to do with why the market went up? Nothing. Absolutely nothing. It's just what I call like a positive synchronicity. A planned synchronicity with the order flow. Well, let's get into the order flow, okay? So, for example, what does it take? If the last price, so here, I just wanted to make this distinction between speculators and hedgers. Hedgers, when they put an order in the market, they don't want to make the price move. In other words, if I'm this generator, this manufacturer of generators, and I need to lock in the price of copper, to lock in my profit margin, when I put my hundreds of copper orders in the market, I don't want there to create such an imbalance in the order flow to cause the price of copper to go up. Because I'm increasing my average price. What I want to do is do it in a way that doesn't create price movement, so that I maintain my average price, or maintain a good average price. Because what happens is that what you have is that for us as speculators to make money, there's only 2 ways to make money. That's it. Everyone's trying to do the same thing. Everyone has to buy low and sell high, or sell high and buy low. There's no other way to do it. There's absolutely no other way to do it. And as speculators, typical screen-based speculators, we don't have the, let's say in many cases, or in any case really, not many, where we don't have the financial or the psychological resources to actually move the price ourselves. Whereas you have to understand that there are plenty of traders out there who do. There are a lot of hedge fund managers and big traders who can, under a lot of different circumstances, actually create price movement purposefully. They purposefully look for situations with what I call like the herd masters. Okay, where they're looking for patterns, they're looking for chart patterns where they know that a lot of what they call weak longs, you've heard these words, weak longs and weak shorts, have gone into the market, and what they want to do is they want to force the weak longs out so they can get into their position at a lower price, or they want to force the weak shorts out so they can sell at a higher price. And they'll look at chart patterns where they know that the typical speculator has gone into the market. They'll hit the market with huge orders, force the price lower or higher, cause the typical speculator to panic cause them to panic, which creates further movement in the direction against the speculator, but what they need is inventory. I'll explain how this works, okay? So for example, buy low, sell high, buy low. If the last price was 9, how does it get to 10? Yeah, more buy. In other words, look at it this way. If you look at it from the exchange perspective, before there were electronic exchanges, you have executable orders. And for every buy order, there has to be a sell order, or you can't execute a trade. On an electronic exchange, it's the same way. There has to be somebody on the other side of your trade. Whether it's a computer program that was designed by a major brokerage firm like Goldman Sachs or whatever, or an actual individual, it doesn't make any difference. There is somebody on the other side of your trade. In every circumstance, in every single circumstance. Which means that if you buy at 9 and the price goes to 10 or 11, who's ever on the other side of your trade is losing money. The money that you're gaining is the money that's coming directly out of their account to the clearing firm into your account. And when the market goes against us, the money that's flowing out of our account, going into the clearing firm, and going directly into the account who's on the other side of the trade. So what this means is that if the last price was 9, how it gets to 10 is that there were no executable. In other words, I have a certain number of buy orders flowing into the pit at 10. There has to be an executable sell order to match up with every buy order. If you're not getting this, let me know. There has to be an executable sell order to match up with every buy order for the price to go anywhere. If there is an even amount of buys flowing into the exchange at any particular moment with the number of sells as there are buys, the price will go nowhere. You with me on this? If there's an even number of buys and an even number of sells, executable buys and sells at this price, the price goes nowhere. It doesn't go up to 10 until there aren't enough sell orders at 9 to fill the number of buy orders for the people who want to buy, or the number of contracts or shares or whatever available on the buy side. And then the electronic exchange, what it'll do is it'll move the price up to 10 to find sell orders, to find executable sell orders. And if there aren't enough executable sell orders to match the buy inventory flowing into the pit, then it'll move it up to 11. When we were dealing with physical exchanges, people actually did this. In other words, what you had are actual traders in the exchange, in the pits, or whatever, who would actually bid the price up. In other words, if they couldn't find any other traders in the pit who they could execute a trade at 9 at, they'd bid it up to 10 or bid it up to 11 to find someone who would sell. Because the whole idea is sell high, buy low, sell high. So the higher the price goes, the theory would be the more attractive it would be for someone to come into the pit and take the other side of my trade. Are you guys with me on this? Yes. So what it all boils down to is that price movement is simply an imbalance between the number of buys and number of sells flowing into the exchange. That's it. That is it. But it has major implications. For example, when I started trading, like I said, in 1978, and I was working in the commercial casualty business. As a matter of fact, I was managing a commercial casualty agency. Just before I moved, pretty much just before I moved to Chicago, I signed a 3-year contract with this agency for $360,000. $100,000 the first year, and $120,000 in the second, and $140,000 in the third. So I mean, I was kind of financially, I was doing good, especially I was in my early 30s, and. But shortly thereafter, something happened. I also didn't like managing. I didn't really like being in the insurance business, and I certainly didn't. I thought I liked management. I did not like management at all. I was a horrible manager. Anyway, just not something my brain was into. But in any case, something happened to me where I felt compelled to move to Chicago because I got a call from like a Shearson broker in the building we were in, and I opened up a commodities account and started trading gold and silver right off the bat. And lost, my first couple of stakes, whatever. I think I started out with a $10,000 account, lost that. Did another $5,000 or $6,000, lost that. Changed my broker, went to a different broker at Shearson, thinking he would do a better job. Had no idea. Remember, this is in 1978, 1979. What we understand about the markets and what's available to us were virtually today were non-existent back then. We didn't even have computers. Okay? We didn't even have personal computers. The only way to even know what was going on was to call your broker 10 times a day or whatever. And also, we didn't have instant execution. What you had is a situation where you want to execute a trade, you got to call your broker, you got to dial the phone, he has to answer the phone. If he's on the other line with another customer, you had to wait. And then once he answered the phone, of course, he had to write out a ticket. The ticket had to be wired down to the exchange. Once it got to the exchange, it got to the phone clerk at the exchange. The phone clerk wrote out another ticket and gave it to a runner. The runner then gave it to the appropriate broker executing trades for that particular firm in the pit. And then the broker would, based on supposedly open outcry, actually, say, hey, I've got 5 to buy or 5 to sell at this price, and then if someone else, maybe another brokerage firm or just a local, some guy trading for his own account standing in the pit, hit the order, hit the bid or the offer, whatever the price was, and then the floor broker would record the trade, give it back to the runner. The runner would then go back to the phone clerk. The phone clerk would go call up or wire it back to the brokerage house, and then the broker had to get back to you with a fill. Okay. And all this cost an average with the big firms like Merrill Lynch and Hutton and Shearson like between $130 and $140 a round turn. One contract trade between $100 and $130, $140. Now, I can't tell you how many times I put in an order later on. I mean, just to give you an example, if I put in an order, to buy silver at $9 an ounce or whatever, okay, that, I'm buying at $9 an ounce, and the market comes down and hits my price, but I'm not guaranteed a fill unless it goes one tick through my price. So if it hits my price and goes back up, I don't even know if I'm in a trade. My broker doesn't even know if I'm in a trade if the floor broker hasn't gotten back to him yet. If the floor broker is busy, it might take 20 minutes, a half an hour. If it's what the exchange classified as a fast market, he wasn't even obligated to get back to me until maybe an hour. I don't remember what it was. So I could be in a winning trade and not know it. I could be wanting to take my profits and not even know if I'm in a winning trade. If I go ahead and just assume that I got filled and, and sold, I could end up being net short, the market's going up and not even know it, I could end up being net short, not know it. The old timers with the, Tony, you know what I'm talking about, right?
Well, you knew you were going to get your foot a while, but here's where my stock is. You get your foot on your stock before you start on your
This was a rough way to trade, people. Yeah. This was a rough way to trade, because not only that, even check on we didn't have price available. We didn't have any prices available. We had to call our broker, 20 times a day. Where's it now? Where's it now? Where's it now? Basically, what you did was trade off daily bar charts from the Wall Street Journal. In other words, you get the Wall Street Journal in the morning and you do your, go ahead, Tony.
And you have a commodity perspective.
Yes, a commodity perspective, right.
It was what?
Yes. And it gave you like 3 or 4 months of bars, daily bars, and it gave you some room on the right there to add your own bars in. Yes.
Remember price.
Yeah.
Because at the end of the day, I got written down there, I trade price. And we remember price that way. Sometimes when you do stuff like that, we're teaching you how. You gotta do that. You wrote it down, you remember it.
So yeah, it's like, there's things that you learn that you sort of take for granted about the way you developed as a result of that. But anyway, this was really a tough way to trade. And so what happened with me, so you do understand the concept that it's simply an imbalance in order flow, right? Everybody with me on this? If there's more buy orders, stuff. So why did the market go up today? More buy orders and sell orders. Why did the market go down today? More sell orders and buy orders. Now, the reason why there were more buy orders and sell orders, how do we know why? In other words, every one of us in the room has a reason. Everyone contributes to the order flow, which means that everyone contributes to the up and the down ticks. Every order contributes to the up and the down ticks. So why did the market tick up? Well, basically the reasons exist in the minds of everyone who put on a trade that contributed to the imbalance between the buys and the sells in that moment. And since the exchange, when we put a buy order or sell order in, since you are not required to attach your reason for doing it. What? That's how the what? Oh yeah, make every give the reason. Yeah, right. Yeah, since we are not required to attach our reasons, and neither is anybody else, then we don't know why other people are doing it. And what's interesting is that as typical screen-based traders, we are strictly dependent on what other traders do after we get into a trade. Since we don't have the financial or emotional resources to be able to move the market ourselves, we'll talk more about that in a little bit. Since we do not have these resources, then we are strictly dependent on what other traders decide to do after we get into a trade. And the reality is, we don't have the slightest idea what they're going to do or why they're going to do it. In other words, orders are going to flow into the exchange after we get into a position. We don't know what the volume we don't know what the imbalance is going to be. In other words, there could be a huge order that hits the market in our favor, but there happens to be a huge buy order. We just got in. There's a huge buy order that hits the market a few minutes after we get into a trade, but there's enough sell order inventory in that moment to absorb all that buy volume. Price goes nowhere. 5 minutes later, that buy order could create a panic, and the market could shoot right up like this. Why did it happen? Because for whatever reason, whoever put the order in, however many traders did it, and for whatever reason they do it, we'll never know unless we have a way, unless the exchange, the reality is, if the exchange gave us the names and the accounts and the names of all the people who contributed to the order flow in any given moment, so that we could go ask these people why they put their orders in the market, then we would know why the price went up or why the price went down. Then we would know the real reasons. Everything else that you hear or read is basically shit that people are making up, and I'm not kidding. And I'm really serious about that. It's stuff that people are making up because they don't know. People don't get on TV or write articles and do it in a way where they don't sound like they know what they're doing, or not gonna do it in a way where they don't sound intelligent or that they know what they're talking about. So even if they don't come right out and say directly, this is why or that's why, they're implying that they know. Which gives us the idea that somehow or another it can be known. And there are exceptions, because if you do know large fund managers and traders who can move the market and they do put in huge orders, and you happen to know that these huge orders hit the exchange, and there wasn't enough inventory on the other side to absorb those orders, and that's the reason why the market went up. If you know that directly, then you know why it happened. And certainly the guys or the people that put those orders in, they know why it happened, because they're the ones who did it. For the typical screen-based trader, this information is, for all intents and purposes, unknowable. So the implications are that regardless of how sophisticated your analysis is, regardless of how good you think it isn't telling you the reasons why. Even if, for example, let's say we're trading a support and resistance pattern, okay, or we're trading, we're trading a retracement, okay. So what we have here, and I put a buy order in right here, and the market shoots up. Is it possible that the reason why other traders came into the market and created an imbalance in the order flow is because they happen to put orders right in there too? Yeah, it's very possible. It may even be likely. Is there any way that I know that? No, I don't know, do I? It's unknowable to me. And if you think that what I'm saying isn't correct, all you've got to do is challenge somebody. Every time you hear somebody say, the price went up because of this, other than an imbalance in buy and sell orders, every time you hear somebody give you a reason, say, prove it. Prove how you know that. Where's the information that you have access to that tells you that that's the actual reason why? Tweet the people on CNBC. Tell them to prove it. Say, prove it. I guarantee you they'll shut up. Because they can't. So anyway, what happened to me was I was with my Shearson broker, didn't know anything about trading, and I ended up, I don't remember why he told me I should do this, but I did it. I just did it because I thought he knew what he was doing, but I don't remember the reasons why he told me to do it. I ended up buying silver at it was around $9.75 an ounce. And I bought two 5,000 ounce contracts. So I was long 10,000 ounces of silver. And shortly after I got into the position, the silver market went down to about $9.50. And so I was looking at a $2,500 loss. So what he says to me is that, you know what, we'll take care of the situation. Since I was long two COMEX silver contracts, what we'll do is we'll spread your position between New York and Chicago, and we will go short two contracts in Chicago. So what he did is he put on 2 contracts, another $280 commission, by the way. So he put on 2 contracts in Chicago. So I was long New York, short Chicago at this price. And he said, when the market goes back in your favor, we'll take the short leg off. Because the whole idea originally was to be long silver, okay? So we'll take the short leg off when the market goes back in your favor. So the market did, it went back in my favor, and he took these 2 short contracts off, but in essence locked in what, a $2,500 loss when he did, right? Okay? That was a realized loss. But then what happened is that the market went back down to $9.50, and he put the 2 back on. What? Now, what I'm about to show you is that in essence, the silver market went into about a 2-week trading range between $9.50 and $9.75. I didn't know what a trading range was. I didn't even see a chart, okay? And I would say that he probably didn't either. Go looking back on the situation, he didn't know what a trading range was either. But what he did do is that every time it went back to $9.75, he took the short leg off and locked in another $2,500 loss. It went back down again to $9.50. He put them back on, and it went back up to say put them on. So he did this over a 2-week period several times. And finally, it got to the point where I couldn't open up my brokerage statements, and I was in an extreme state of distress. And until I got to the point where I just woke up one morning and said, I can't take this anymore. And I went into my office and I called him up. I said, just get out of it. Just get out of everything right now. Oh, man. This is probably the reason why I'm here today, okay? I'm not kidding. In fact, it is. Because about Oh, I'd say 20 minutes or half an hour after making this call to get out of everything, the market finally broke out. The market finally broke out of this trading range. Yeah, no, this isn't it. No, this is the worst part of it. The market finally broke out of this trading range, and of course, we never saw this price again because shortly thereafter, within a couple of weeks, you remember the Hunt Brothers debacle? Okay, I was in what you'd call the perfect trending market. It couldn't, when I say the perfect trending market, I mean it was absolutely, because what's a perfect trending market? One that virtually goes straight up, right? Okay, no retracements? Well, the market couldn't go straight up because the exchange imposed price limits. In other words, the exchange says that the price of anything can't deviate by more than, let's say in silver, I think it was 50 cents a day. I think it started out, it was 50 cents or $1 a day. I don't remember what it was. Anybody remember silver what the price limit was on silver? Tony, do you remember? Back in the early 80s or late 70s, what the price limit on exchange imposed price limit on silver was a day? Was it about 50 cents or $1? It had to be $1. What?
I think it was $1.
Well, yeah, it started out at 50, but it went to $1.
Well, he had 3 limits in a row. Then they started.
Yeah. Okay. So you know what I mean by limit move? Everyone knows what I mean by limit move. Okay. In other words, when the price went to let's say 10.25, we started out at 9.75. We started out at 9.75. If the price went to 10.25, that's a 50-cent move, and the exchange says, okay, no, we're not going to execute any more buy orders. It doesn't matter unless there's enough sell orders. Unless there's sell orders, of course, to take the other side. But if there aren't enough sell orders, we're not going to execute. In other words, we're not going to let the price go any further than 10.25 today. Okay? Now, we don't know what's going to happen tomorrow morning when the market opens. But in this case, instead of having a bar chart that looked like this, because a bar chart would imply that there were trades within those bars. The silver market, in our charts, the silver market looked like this. They were dots. This would be a day, this would be a day, this would be a day, this would be a day. They were dots because there were no trades. Because there wasn't anybody willing to take the other side of these buy orders. In other words, we had a flood of buy orders into the market without any inventory to take the sell side. So the exchange had to move it up the limit for the next day, and then there weren't any sell orders, limit up again. This would be a perfect trending market because you don't have to deal with retracements. Okay? And then it went all the way up to $49 an ounce. Basically, I was like that close to, in my mind anyway. I'd have never hung out to 49, but at least at the time, I was like that close to what I thought was $400,000 on a 2-lot.
And it didn't take long.
And no, it took 30 days or so, a little over 30 days. Now, the reason why this happened is because the Hunt brothers who were Texas oil millionaires or billionaires or whatever, they got the idea that they were going to corner the silver market. And the way you corner a market is, one, you start buying up as much cash silver as you can. You start accumulating a huge inventory of cash silver bars, whatever, okay? And then what they did is they went into the futures market and bought as many futures contracts as the exchange imposed limits would allow them to. However, and that was quite a few futures contracts. But see, what they did, and the reason why they ended up taking a huge hit on this whole deal is because the exchange said that what they did is they bought more than the limit through other entities that they said they had no relationship with, but the reality is they did. So here's the deal. Here's how a market gets cornered. Is that if there's a buyer for every seller and a seller for every buyer, and at some point, futures contracts expire. And when they expire, if we're not out of our side of the contract, we have to execute the contract. So if I'm on the buy side of this futures contract and I don't get out when the contract expires, I have to deliver 5,000 ounces of silver to whoever's on the sell side at the particular grade that the contract specifies at the price that I got into the contract with. Everybody with me on this? Okay? And as a seller, if I'm not out, I have to take delivery. Well, what ends up happening is that as contracts come to expiration, everyone starts unwinding their trades. Meaning the buyers sell, the sellers buy, and what once existed as open interest starts reducing down to very little, if almost nothing, and the few that are left are the ones that want to take delivery or make delivery. Everyone else had no intention of taking or making delivery, but what the Hunt brothers decided to do was they wouldn't let the sellers out of their contract. In other words, what they did is they'd accumulated tens of thousands of buy contracts with no intention whatsoever of unwinding that contract, of actually selling it before expiration, forcing all the sellers on the other side to go into the cash market and deliver silver to the Hunt brothers. And at that point, the Hunt brothers had so much silver, they're basically having to buy the cash silver from the Hunt brothers to deliver silver on their futures contracts, forcing the price of silver to up $40 an ounce. Is everyone with me on this? And then when the COMEX said, hey, you know what? COMEX said, they said no more buy orders or whatever. Anyway, what went up, limit up 40-some days in a row, and limit down 40-some days in a row. And the Hunt brothers took the gas on it. They ended up losing all that money. Is that what they did? Yeah, I don't remember what they did exactly.
At this point, you're not allowed to buy. We're only taking sell.
Yeah, right. They said they're only taking sell orders, right? Yeah, well, whatever it is, yeah.
Right. And do you mind if I just jump in?
Yeah, go ahead. No, come on. Yeah, go ahead.
Start for my feet, but
You need the mic? You need the mic?
No, I got a good point.
Okay.
The market's going to do, don't ever think a market can do, always can never do that, because the market can't go wherever it wants to because it can. And during this Hunt brother with silver going living down 8 days in a row, the chairman of the CME, Jack Sander, had a hog position on it. And there was a report on it. And the report was very bullish. The hog should have gone limit out. It was limit down for 3 days because silver was going. And Jack Sander was the chairman of the Chicago Market Exchange, and this was limited down away from being lost. And that would not have made the Chicago Exchange, which was still kind of in its, infancy, shall we say, not even its infancy, but still.
Yeah, pretty much though, yeah.
And that would have made the exchange look good. They were limited down for the third day. He walked out of the exchange and went to St. Peter's Cathedral. And came back and the hog market turned around. But the last thing that I was saying is, it doesn't matter what you're trading. Something else, especially in these markets today, something else can go wrong. And you're like, well, why is that affecting my stock? Because it can. Because it can. Like how long do you have to go in there? Oh, right. Sorry about that. But anyhow, a market can go wherever it wants. And just don't think that it can't. And I'll do one more thing out there. In 1987 during the crash, if you were short puts, S&P puts, you obviously got hammered. If you were short calls and the stock market went up 500 points in one day, you got hammered because volatility.
Oh, volatility, yeah. Right. So I've been on the wrong side of one of those. The market's going in my favor, and because I shorted the puts. It was in the D mark, and the market was screaming in my favor, and I'm losing money because of the volatility.
Right. Yeah.
I didn't think. I knew theoretically it could happen, but when it really happened, it's like, oh, okay, this really happens.
These were market makers that went out of business during the crash, and they have lines. They went all over guys. We're broke. We're broke. And they show up to clear the next day. I know my husband's cheating on me. Blah 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 blah. I know he's not cheating on you. We will take the fur coat and the ring.
Wait, hold on. Okay, just a little off, but just because you're on the floor. Do you personally know anybody that did a Rio de Janeiro trade?
Oh, no, but I never did. But
do you know anybody that did? Or?
No, I never did.
Does anybody know what a Rio de Janeiro trade is? What do you think? What do you think it would be? No. It would be some trader, floor trader, who's he's ready to tap out. He knows he's ready to tap out. Now, keep in mind, this is at a time before electronic exchanges, before electronic trading cards, where the floor traders didn't have to turn their trading cards in. In other words, all the trades they made during the day, they didn't have to turn it in until the end of the day. And so the clearing firm, the brokerage firm that cleared their trades, didn't know where these guys were at. Meaning, they didn't know how much money they would have won or lost until all these trades are reconciled with all the other brokerage firms that they traded with. And so what they would do is, if I'm ready to tap out, and so I'm going to put on this huge position that I can't afford. And so what they do just before the close, they put on a huge position. Let's say they go long T-bonds, okay? They do 1,000 T-bond contracts. And at the same time, they buy a ticket to Rio de Janeiro. And then what they do before the open, they go to O'Hare Airport and then wait for the open, and if the market opens in their favor, they come back. And if it doesn't, they get on the plane.
And actually, the way I heard it is, they buy those 1,000 contracts right before unemployment, right before.
Oh yeah, whatever. Yeah, so yeah,
before payroll's done,
yeah. Where they take a huge guess. Another yeah.
And then they go to the airport, and at 7:30 Central Time, they call up. There's the bonds.
Yeah.
I'll be back. I'll be right back. Oh, okay, goodbye.
Yeah.
And I've got a crash ship 87 story of my own that I'll show you guys tomorrow about the clerk coming up going, "Where's your cards? Here's your cards. Don't worry, get away from me."
Oh yeah, right.
Get away from me. I read bus, and then my biggest day ever on the day after the crash day. So.
Wow. Okay, so you guys kind of getting the idea here. This business is a lot different than what most people think that it is. Okay, it really is, and and the implications are that if you don't know the reasons why other traders are extending their orders into the exchange, and then you don't know why you're winning or losing, and there isn't any way to find out. Just think about the implication that you don't know why you're winning or losing, which means the whole idea of being right is irrelevant. Your predictions can be right, but your reasons for making the prediction are, you don't know, you can't ever verify. You can't ever verify if they're actually correct. They might be, but if you can't verify it, then what's the point of even thinking that you're right? It only gets you into a lot of trouble. Because thinking that you know, if I'm right, it must mean that I know, and if I know, it means I can eliminate the risk the next time. And the risk can never be eliminated. So what happened to me is that I missed out on what I thought was $400,000. It just really ate at me. I mean, I can't tell you just how anguished I was when this happened. And so it didn't really take much for me to say, you know what, I'm going to Chicago. And, so the first thing I did, I thought, I checked things out, and I found out that Merrill Lynch, their retail brokerage office, Merrill Lynch Commodities, they're on the second floor of the Chicago Board of Trade, and they had 3 positions that are opening. They're going to be open for trainees. And my understanding is they had over 1,000 people apply for those positions. And so, how was I going to be one of those guys that the 3? What I did, because I lived in the Detroit area, I went and applied for a Merrill Lynch position at a branch office in the Detroit area. Went through the whole process because they had aptitude tests, so you had to take aptitude tests, but here, the most important part of the process, I thought anyway, was that there's a multi-page application because of the tests, but otherwise there was this box at the back, at the last page, and in this box you had to spontaneously write there was a question that was asked. It was somewhat philosophical. It was somewhat of a philosophical answer because they wanted to know probably, how focused and how well you could write something like that under the pressure of being in a job interview. So anyway, what I did is I assumed that the whole process would be the same at the Chicago Board of Trade, and it was. But what I did do is I spent probably 2 or 3 weeks agonizing over every single word of that answer. I mean, and by the time I was done, I even had to admit it was somewhat brilliant. Okay, so I went and applied at the Board of Trade, and of course I aced the aptitude test because I've already taken it. And then, if the branch manager thought that I wrote that answer just sitting there spontaneously, okay, because I had it on a 3x5 card, he's got to think, this guy, hey, I'm going to hire this guy. And that's how I got the position at Merrill Lynch. So then, people, it's like, no, what did I get myself into? I got myself into a $20,000 a year draw on commissions. That's it. A $20,000 a year draw on commissions. I left $360,000 for a $20,000 a year draw against commissions, and there wasn't anybody in my life that didn't think I was absolutely stark raving out of my mind. Like, how could I do it? It was easy. In my mind, I wasn't giving up anything. Now, it wasn't a revenge trade. I just thought, look, I didn't know anything about trading, and I got myself into a trade that had a potential of $400,000 on 2 contracts. What did I know about the markets? Virtually nothing. What did I know about trading? Virtually nothing. So, in my mind, did I give up $360,000? Not really. I'm going to go make this when I get to Chicago. I'm going to be on the inside of the business. And as a result, I'm going to learn how to trade. Only to find out that, especially back then, there wasn't anybody at Merrill Lynch who knew how to trade. Seriously, I'm not kidding. I'm really not. I'm not saying that facetiously in any way. They didn't know how to trade. They knew how to talk about trading. They knew how to open accounts and teach you how to open accounts. In fact, I went through a 30-day training session in Manhattan, and not one moment of that session was spent on teaching us how to trade. It was all about how to sell your customer and how to talk about trading in a way that made it seem like you knew how to trade. So when I got on the inside of the business, I was outraged. Seriously, I was enraged. I really was. And it took me a while to get over that too. But anyway, the problem is that here, I gave up all this income, and I had money, but it was like, I also had an extravagant lifestyle. I still had a house in the suburbs of Detroit. I had a really nice, apartment in downtown Chicago, not that far from, the Board of Trade. I had a Porsche. I had a girlfriend in, the Detroit area, and, going back and forth every weekend, and, the whole works, right? I mean, just like, just my lifestyle could only be supported if I made money as a trader. Yeah, exactly. That ain't gonna happen. And at the back of my mind, it's like right after even I get there, it isn't too long for me to start figuring out. You know what? This isn't adding up. This is not adding up. It's like nobody knows what the hell they're doing with respect to trading. Anyway, I started making friends with floor traders, thinking they knew what was going on. They're in a completely different world. I mean, floor traders and direction-related traders like what we do, screen-based traders, we call each of the floor traders will call what they did as trading. We call what we did as trading. We're in completely different worlds. They did not make, in most cases, did not make direction-based decisions. They made scalping decisions that turned into direction-related trades. I'm not even going to get into how all that works. It's just not necessary. All I'm saying is that, and not only that, they're also boom and busters too. So all this is like, it's like, whoa. And so it's getting to the point where, as things are going on, and I'm doing, not only that, one of the good things about being at the board, or in that Merrill Lynch office, is that they had a computer, or a terminal actually, that had a direct phone line to a mainframe computer in Boston, I think at MIT, that I could call up a tick chart even on anything at any time. In other words, if this would have been in like 1981, if I wanted a tick chart of wheat on Wednesday, Wednesday, March 14th of 1951, it would give me one. And I'd build a tick chart, all the way to the present moment. And at the time, I was doing point and figure charts, so like I could build up point and figure charts, anytime, they're not based on time, but any box, any reversal size, and it would go back as far as the contract went back. So, and I spent almost all my time at that terminal learning technical analysis, whereas there were like there were over 40 brokers in that office, and I was the only one that used it. I was the only one that used it. So anyway, like I said, things aren't adding up, and it gets to a point where I'm running out of money because of my lifestyle, and to the point where it looks like I'm going to have to file bankruptcy because I don't have. And the other thing that was so important in my life, even at the time, probably one of the most important things in my life was my credit. I would do anything to maintain flawless credit. Whatever it took, anything. So the idea of not being able to pay my bills was completely unacceptable to me. It was like I believed that if I had to do something like that, I would fall through the cracks of society and never reemerge. You might think I'm just saying this. These are not words. These were a reality in my mind. I could not fathom what that would be like. Just couldn't. But in essence, that's essentially what it came to. Now, if you're thinking to yourself, okay, as you realized that, that you're running out of money, and I wasn't running out of money because of trading losses either. I was trading, and it wasn't because I didn't take big losses. My problem as a trader was because of all the pressure that I had of having to be successful, of having to prove that I didn't make to family, friends, whatever, that I didn't make this asinine decision of leaving $360,000 for a $20,000 a year draw against commissions, that every trade took on the significance of, took on just a degree of importance that was just way off the chart. And so if I took a losing trade, every trade had to work. I was working off a level of 100% perfection. Every trade had to work. And if it didn't, it would set me into an emotional tailspin to the point where it took me days, if not originally almost like weeks, to recover. Now, in the meantime, so to recover to the point where I didn't want to even have anything to do with the market. I didn't want to watch the market because it was so traumatic. But as a broker, I was in a position of maintaining my customer accounts and giving them recommendations. So what would end up happening is that as I'm keeping in touch with the markets for the sake of my customers, I'm giving them my best edges, which in many cases were really good. But when I talked to them, it's like it always came with a disclaimer like, this trade might not work. And so, it resonated as a truth when I said it to them, but in my mind, it was just lip service. Seriously. Just like, I'm going to get into a trade that's going to work, or that's it. So what ended up happening is that I would take a loss, and then I would be in a position where I'm giving my customers my best edges, and and all I had to do was fill out a ticket for me, but I couldn't do it. I was paralyzed because this was the hard, like with the situation with John about realizing that he was in a hero cycle. My cycle was that by taking a loss, I didn't deserve the next trade. It's like I was punishing myself. I didn't deserve to participate in the next trade. And when that next trade was a winner, it would put me into a state of anguish that was so painful that it had actually the positive benefit of knocking me out of it, because it's just like the sense of self-preservation would kick in. And it would have knocking me out of the sense of anguish that not wanting to go through that kind of pain again, I would be determined to take the next trade. Especially when that next trade that I didn't take was a winner, and they almost always were. So here my customers were benefiting from these winning trades, and what I needed so desperately, I wasn't even participating in. But in any case, it was a real bad way to trade, so I ended up losing. Like I said, I didn't end up having to file because of losses. It was the fact that I wasn't making the kind of money that I needed as a trader. So if you think to yourself, well, okay, as your expenses were way out of sync with your lifestyle, why didn't you cut back on your expenses? Well, think about that for a moment. If I cut back on my expenses, I'm admitting to myself that I'm failing. Even thinking about it would be putting me into a mode that I'm admitting that I'm failing. And what made it even doubly more difficult to make that admission is the fact that I had a really good win percentage. I came up with good trades. If I could execute them, I'd have been all right. So it just always seemed like I was only 2 or 3 trades away from everything being all right. So how can I admit that I'm failing? Until I literally did not have any more money to pay my bills. And then I called, credit cards, and even called GE Credit, who, had the Porsche, and I wasn't even late. Wasn't even late. And I said, hey, come and pick up the car. I can't pay for it. They're out in Bloomington, Illinois. And what was really interesting about that, you want to hear this? I don't know if you want to hear it. It's a cool story. The guy they told to come pick it up, I met him out in front of the apartment building. And I can't use the exact language his supervisor used, but I'm thinking, you know what? This guy's picking up my car, or was my car, and I want a note that says what condition it's in. In other words, I go back and make things right. I don't want the car, going back to GE Credit, dented up or whatever, that, any kind of situation that I didn't occur. And I said I wanted a note. And he said, I'm not going to give you one. And I said, you're not going to get the car. And so, we went back and forth on this. So finally, he walked into the lobby and called the supervisor. And I could hear his supervisor on the other end. I said, if you have to blah, 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 this guy's whatever, you get whatever you do whatever you have to do to get those keys. He's screaming at him. So anyway, I can't use the language, but it's like, you can imagine what he said. So, but yeah, so what ended up happening is that I lost all my possessions, other than the fact that I still had my job at Merrill Lynch. When I filed, I did so in the Detroit area because I had a legal residence. So nobody at Merrill Lynch knew what had happened. They would have fired me immediately. And I was in the unique position. Now here's what's really critical about all this. I was in the unique position of legitimately having tapped out as a trader and still able to trade. Still being connected with the markets. And I had also the added benefit of just always sort of knowing right from the very beginning that trading was about psychology. As a matter of fact, the very first book I ever bought the very first trading book I ever bought was Jake Bernstein's Investor's Quotient. It was published by Wiley in 1980. It was more on a clinical level, but that was the very first trading book I ever bought. It was on psychology. The only one actually, like I said, the very first, I don't consider Reminiscences of a Stock Trader like a real psychology trading book. So Jake's was the very first book. Actually, The Disciplined Trader was only the second. The Disciplined Trader came out in 1990. Yeah, at that time, it was only the second book ever written on the psychology of trading after Jake. And even at that time, there weren't any universities that had behavioral finance programs. It just, the whole idea of trading psychology in the industry was completely this doesn't have anything to do with anything. So anyway, what ended up happening is that it was real cathartic because I ended up realizing that I was more than my possessions. Like after, I don't know how many weeks it took, but I was starting to reassess my identity. When you have all these possessions, that are on the outside of you reflecting what's on the inside of you, and then all those possessions are gone. It's like you've got to reassess who you are. And then I came to the realization that I'm more than my stuff, and I'm going to be all right. And it's when I really genuinely came to the conclusion that I was going to be all right that I didn't have anything to lose anymore, and I saw a different market. I come in and it's like it was like almost like things became self-evident. When I didn't have anything to lose, it's like I was completely detached from the outcomes, and with being completely detached from the outcomes, I was in an objective state of mind, and it all became easy. It really did. Someone has a story here. I don't remember your name, sir. Oh, because you didn't have a tag on. Scott, you want to say your story? Yeah, you've got 15 seconds.
I've been trading about 13 years now, and it was sort of on my own time, learned from two other guys who were the 3-point license. And I learned a lot of bad habits by taking monitors and taking personal. And I had read one of the books 4 times total. The 3 times before, I understood the story, so I didn't make a connection. And the 4th one, it happened after I took the loss of what I considered treasure. And it was to the point of just a kid right on the edges. You had nothing left to lose. So when I read the book, October, November,
The fourth time.
I get it. And my trading was fun, because I know I was not trading was fun. And I kept myself because that's up. And then in the spring, I worked with government, and we walked the Casey trade where the Casey are trades from nothing. And the whole green weekend, I watched 4 or 5 months of stuff, and I got it. Sold off in that one morning, 10 days, I had a 54% capital. So, professional headache was like, that's not the trade future, I don't have a lot of time to go. This gave another tool to go off the trade, and it sounded fun. So I still wanted to, it's a pain in the and he said, yeah, that stress, you paid me. So that was my story. Now my trading has been fun, so we can start to fun. And enjoy it.
Thanks, Scott. Appreciate it. Thank you. That's it. Put it up there. It's all right. So anyway, before we break for lunch, there's some stories that I want to go through that'll illustrate these points when I was at Merrill Lynch. First of all, if you're interested, why did I leave Merrill Lynch?
Yes.
Okay, I got fired. And no, the reason why I got fired is because in the summer of 1982, this whole situation was like around April of 1982. By July of 1982, I'm thinking, you know what? As I experienced a different market because my perception, my perspective had changed, I thought, you know what? I got to write a book about this or a seminar. I didn't think about really a book, but I thought more like a seminar. And I actually started writing it in July of 1982 in the boardroom overlooking LaSalle Street. There was a huge picture window there, on the second floor of Merrill Lynch, okay, or second floor of the Chicago Board of Trade. Anyway, about 9 months later, 9 or 10 months later, some management consultant from New York came to our office. She had some agenda. I don't remember exactly what it was, but she was interviewing all the brokers. And she got to me, and I told her that I was writing this book on the psychology of trading. She lit up. I mean, she honest to God, she just lit up, and we talked for about an hour, and I told her what I was doing. She said, "This is exactly what we need. Boy, this is great, blah, 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 blah." And so, when we were done, she went right into the manager's office. She was in there for about 15 minutes or so. Manager came out and said, "Pack your shit up and get out of here." Did not want anybody on the inside of the industry writing a book. Now, it's not that he didn't know what I was writing about. He didn't want to take the chance. He just said, "Get out." That was it, right then and there. So I said my goodbyes to everybody and left. But anyway, here's some things that illustrate some of the points that I learned while I was at Merrill Lynch. One, there was a book that I bought, New Technical by Wells. I don't remember the name of the book. Anyway, all it was there was about 5 or 6 technical, rudimentary, by today's standards, very rudimentary technical systems that Wells Wilder, the author of the book, actually gave you a spreadsheet for, so you could actually do all the additions, multiplications, and divisions all by hand because we didn't have computers, and based on daily charts. And some of these signals were really quite accurate. I mean, they really were. They're based on, like I said, daily charts. They're really quite accurate. And so I started using them for my customers. And so one of the things that surprised me, because I was making friends with a lot of floor traders, is that when I got a signal, in some cases it was absolutely perfect. It's like, get me in a trade that that I didn't take any heat on whatsoever. And I'm thinking, I remember exactly thinking, is this the reason why the market's going in my favor? But I do have a recollection, like if it was a bond trade, of going out to have some beers after the market with bond traders, and they're telling me about the activity in the pit, who's buying, who's selling, volume. And I'm thinking, there is no connection whatsoever between my winning trade and why the market went in my favor. I mean, zero. Were those floor traders using this system? Absolutely not. Zero connection. The next one. Sophisticated financial news channels didn't exist back then, but we did have this local cable channel in Chicago that during the day they had financial news or whatever, stories. And it was, like I said, really rudimentary by today's standards. So the TV would be on constantly, so you could watch it if you wanted. And we also had CNBC, what they call, in the morning they call Squawk Box. Well, everyone know what a Squawk Box actually is? Because they really exist. A Squawk Box was an open phone line between all the different pits that would be traded. That we would we'd have a speaker located in various parts of the office so everyone could hear it, and there would also be an open phone line in the hog pit, the bellies, the T-bonds, the S&Ps, you name it, the currencies, whatever. And there would be Merrill Lynch employees whose job it was to go to these various pits throughout the day and report about who was buying and who was selling and how much. Okay, so-and-so was doing this, so-and-so was doing that. And so I'm watching this local channel, and they're interviewing some vice president from Heinhold Commodities. Heinhold Commodities, I don't think they exist. I'm sure they don't exist anymore. But they used to be one of the biggest hog producers in the world at the time. And so their vice president was being interviewed by the guy on this cable channel, and he's just talking up, buy hogs, buy bellies, and it's like, and the office was relatively quiet at the time, and then all of a sudden the phones started lighting up. literally, and lighting up because you had a lot of local commodity traders, off the floor traders in the Chicago area who watched the station. And so what are they doing? They're buying hogs. They're sending orders to their brokerage firm, and in this case, in this case, Merrill Lynch, buying hogs or buying pork bellies. And so, this is a coincidence. It just so happened because the guy, the Merrill Lynch employee on the floor whose job it was to report what was going on in the pits, he wasn't watching that station. He wasn't watching the local news cable station. He didn't have any idea that there was some high-hold vice president on TV telling the basically retail customers to buy hogs. But he just happens to walk into the hog pit because he hears all this activity. He sees all this activity flowing into the pit, especially into the retail brokerage deck holders, and he wants, say, he'll go report on what's happening. So he goes on the pit and say, all these retail orders are sure send Merrill Lynch, blah 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 blah. And guess who's on the other side taking the sell side of those orders? High-hold. They needed inventory. They needed buy inventory to absorb their hedge without affecting the price of the market. This happened a lot. This was not an isolated incident. This is the kind of stuff that goes on all the time, or did. This probably still does. I don't know. And so, and the next one, the last one that really where I really for sure had to write a seminar is because when I was at Merrill Lynch, what I saw is all of our customers making all the same kind of mistakes over and over and over again. It was just like there's the typical things that we all basically had the same problems and making the same kind of mistakes. And I inherited this guy as a customer. He was from India and had a real heavy Indian accent, and he was the main. He ran the state of Illinois' main computer banks. In other words, the mainframe computers. And as a result, since he had access to these computers, he was also developing trading systems using the computer. And so, like I said, I inherited him as a customer. He didn't have an active trading account because his wife wouldn't let him trade anymore. But he did have an open account. So he would call me every day, and he was not a very personal guy, because I'd pick up the phone and he'd say, "Give me data." Okay, so I give him the data that he needs, and eventually what he did is he came up with a system that was really quite accurate. In other words, at least entries anyway. He had really accurate entries on a daily trading system, like on the open, on the close kind of thing. What he didn't have was exits on the loss side and profit objectives. And so I worked with him for about a month on this and came up with a really viable system. It was working, and not only was it working, it was starting to take notice from Merrill Lynch management because my customers were making money. Literally, and that's not something that really happened in a retail brokerage firm. So, and then it got so good that he talked his wife into putting $5,000 in his account, and it was like, whoa! It was gone in a day and a half. It was like he called me with the signals, but then he'd say, "Well, do this." I said, "Well, no, then our signal, we're going to do this." For his account, no, do this. I said, "No, the signal is to do this." He said, "I know what's going to happen, do this." And he lost the $5,000 like that. Just like that. Not following one rule of his. We had a track record. We had a legitimate track record that was working. And he couldn't take one trade from his own trading system. He pissed away the $5,000 in a little under 2 days, and his wife said, "That's it, no more." And that was it for me too, because he closed the account and I never heard from him again. And since we didn't have mainframe computers, nor did I have access to what variables he used to call for the signals, it was done. It was those kinds of experiences, like, I got to do something to get people in tune with what's really going on here. First of all, don't let me forget, tomorrow I'm going to start out showing how fear acts on our perception of information and our behavior in a way that causes us to actually experience the very thing we fear the most. And then we're going to put it all within a context of a step-by-step methodology of how to actually instill these principles in your mind as core trading beliefs so that you're not afraid anymore.
Your story about newscasters that say 5 pork bellies and then
hogs, yeah, right.
Isn't that sort of opposite of what you said? Like, how do you know that's what it was? How did that influence you?
What do you mean? What are you saying?
People always say this is why things happen, but nobody knows you can't prove anything. You're just stories.
Okay, but what does that have to do with what the story that I said? Yeah, he did that because he did. No, he went on TV to tell people to do that, so there were orders to take the other side of his trade. He needed inventory. In other words, remember, prices move based on an imbalance between the number of buy and sell orders that come into the pit. But he's a hedger. He doesn't want the price. He doesn't want his sell order to cause the price to go down because it reduces his average price. He wants to sell at the highest price possible. The only way to get his price at the highest price possible, if there are enough buy orders to take the inventory of the amount of sell orders he has to sell. So he went on TV encouraging people to be buyers so that there were enough orders to fill his hedge. He didn't want the market to move. Go ahead. Oh, in this case, yeah, absolutely. Yeah, see, remember, I didn't say that was an absolute. I didn't say it was an absolute because the Merrill Lynch employee was right in the pit seeing who put the order in. He still didn't know why. The Merrill Lynch employee said, hey, you know what? High and hold is selling. Here's how many. He didn't know that they were putting on a hedge. No, it wasn't a good bet at all, actually. No, it was a complete scam. No, what are you saying? No,
I just said that this person that ordered maybe days after someone ago.
Maybe we say ordered. Ordered what? What do you mean?
Place the order for
I mean, place a buy order or a sell order?
buy.
Okay, they're putting buy orders in.
Earlier you were saying you don't know that people are wet market looking much but buying.
Right.
Looks like this guy came on TV.
Oh, absolutely. Yes. In this case, I would say because the coincidence of the phone, of him being on TV and the phone's lighting up, yes, I could say in this instance that probably the reason why those buy orders were flowing into the pit, yes, did I know at that, the probability is, yes, it seemed like I contradicted myself, but I really didn't because as screen-based traders, remember, I was on the inside. I was in a brokerage firm with access to information that we don't have as a screen-based trader. Remember, I qualified it by saying, as screen-based traders, there's no way to know. Was that part of your question? Okay. Yeah, remember, I was on the inside. So I could see the correlation. Go ahead.
Did you ever ask any or all the students who never did any of the protocol why they never did it? Going back about a quarter of the way of your presentation that you talked about.
I wouldn't ask. That's not something. No, I kind of know why. I can extrapolate why, but no, I wouldn't ask. I really wouldn't want to say, actually. And I don't want you guys to not do it. Okay, so what? Well, you might not want to if I gave you the answer. It's right. It's what you're going to learn. Not everyone's ready. Not everyone's ready to step into what they're going to find out about themselves. That's right. Not everyone's going to want to know what they're stepping into and what they're going to learn about themselves, because the implications are pretty powerful. It takes away a lot of people's excuses for being unhappy and a lot of negative things that go on in their lives that they'll learn they can do something about. Because if you can change one belief, you can change any belief. So there, I answered the question. That was a good question, by the way. One other thing. Another thing. Okay, because I don't think I finished this. Yeah, another example. There was one particular example where the bond market had really established support and resistance zone. Okay, and this was an intraday trade, and the market came down to support and bounced right back up off, came down to support again, bounced right back, and now it's coming back down again, right? Okay, and so like the third time, I'm getting everyone in this trade, and what does the market do? It just blows right through it. Now, it's like under normal circumstances, I wouldn't have the slightest idea what happened. It just so happened that because, again, I was having beers with guys in the bond pit that, who were in the pit that day, asking them, hey, you know what? When the market was at this price and it bounced, the market was at this price and it bounced, and then it hit it again, an hour or so later, and it blew right through it. What happened? Oh, well, there were 4 or 5 really big bond traders who were supporting the price here. In other words, more buy inventory than sell inventory. They did the same thing again here. They were out to lunch here. They went to lunch. I lost money because, or my customers lost money because they went to lunch. That's why the trade was a loser. Hey, see you tomorrow. Okay, before I ask you guys if you have any questions about some of the stuff we did yesterday, I just want to elaborate on something that John just said, because it's really important. He said, when you understand probabilities. There probably isn't a person in this room who doesn't understand probabilities. It's being able to function from a probabilistic perspective. There can be a huge reality gap between, let's say, our understanding of what it means, of what probabilities mean. Like, saying, hey, our pattern gives us an edge, over a series of trades, over a series of 10 trades, 7 are going to be winners, 3 are going to be losers. The problem is we don't know which ones are going to win and which ones are going to lose. So if I'm going to actually extract the profit potential in that edge, it requires that I be able to take every single trade in the series or the sequence without making errors. Makes sense, right? Wait, understanding that and believing it at the core of your personality so that you can actually do it are two completely different things. We can say we can think of ourselves as a probabilistic thinker. Say, yeah, I get it, I understand it. But if you can't execute all 10 trades flawlessly, then I can guarantee you you can't function at a probabilistic perspective. Because when you can, you will be able to lose without thinking you're a loser. You will be able to be wrong without thinking there's anything wrong with you. Because that's in essence where we're going. This is what makes trading so hard. We live in a society that's completely obsessed with winning is everything. Avoid losses at all costs. Winning is everything. Avoid losses at all costs. These are very powerful belief systems. You think they're just going to go away and not assert themselves on what you do and how you behave just because you have this understanding in probabilities? Just because you might read a book or go to a conference and say, hey, you know what? This is a probabilistic environment that we're dealing in, and you got to think in odds. Oh, yeah, that makes sense. I can see that. Try doing it. Because what you do is going to be a function of what you believe. And if you can't do it, it means that there are conflicting beliefs that say that, you know what? No, this is not right. I think my analysis should tell me what's going on. And even though at a conscious level you're thinking, no, that's not what this is all about, it doesn't mean that that energy isn't asserting itself on how you behave. Otherwise you wouldn't be afraid. You were at the casinos last night. How is it that if we lose, it taps us into, we've had a losing experience. It can tap us into all the accumulated negative energy, like I put yesterday, of what it means to lose in our life. Losing has the potential to tap us into all this negative emotional energy. I don't want to feel that way. Most people with, let's say, a normal psychological makeup also don't want to feel that way. We will avoid this at all costs. I don't like the feeling of what it means to be wrong, all the negative energy. Brings up all the times we're berated as kids, someone ridiculing us, teachers, coaches, whatever. So if my trading experiences have the potential to tap me in to these two belief systems, or these memories, the memories of what it means to lose and what it means to be wrong, well, you know what? I've got big problems, because you know what? If I can't lose and I can't be wrong without it resonating, negative emotional energy, there's only got one other way that I can think of to help me avoid tapping into all this, and it's through analysis. So in one sense, we're going to say, well, I'm a trader, which means I'm a risk taker. But the reality is we're using analysis to do everything to avoid tapping into the memories of losing and the memories of what it means to be wrong. And it doesn't work. What we're trying to tell you is this doesn't work. Because there isn't any analytical regimen or system that you can come up with that will guarantee that the next trade is going to work. What technical analysis does is it defines patterns. In other words, when we got the order flow, we got buys coming into the exchange, we got a flow of sells coming into the exchange. When there's an imbalance between the buys and the sells, and there's no buys, the price has to tick up. When there's an imbalance between the sells in relationship to the buys, the price has to tick down. As these price up and down, as the price ticks up and down, up and down, up and down, up and down, it creates what we call collective behavior patterns. I say collective because everyone who submits an order to the exchange contributes to the pattern. And what we found is that not only can these patterns be identified, quantified, but they repeat themselves with statistical reliability over and over and over again in every time frame. You guys with me on this? Where's the problem? What? Go ahead, Tony. Oh, well, yeah, no. The problem is the patterns repeat themselves over and over again with statistical reliability. The outcomes that the patterns are predicting are random. I want you to get this. This is big. Okay? The patterns repeat themselves with statistical reliability, but the outcome that the pattern is predicting is random in relationship to the previous outcomes. There's a completely random distribution between wins and losses over a series of edges, or the criteria that define your edges. Exactly. That's right. That's how casinos make money. They're gambling on each individual. They know that's a gamble. Each individual outcome is unpredictable and unknowable. But over a series of events, the law of probabilities will work its magic, and they don't need to worry about the outcome to each individual event. So now you tell me, nobody likes tapping into the pain. No one likes tapping into the pain, and yet walk into the casino and watch people sit in front of a slot machine for hours and pump money into that machine, knowing they're going to lose. Not only knowing they're going to lose, experience losing, and why is it that they're not experiencing emotional pain? They are losing. Why aren't they experiencing emotional pain? Well, it's one at a time. Somebody raise their hand, whatever. Go ahead. Yeah, let's put it this way. You say they're expecting the next one. They don't know if the next one's going to be a winner. The next one may be a winner, and the whole idea of it being fun is because they're going to be surprised if it is. But the point is, they are expecting wins and losses. As a matter of fact, if you watch somebody play slots or you experience playing slots, you know that you're going to lose more times than you win. And as long as you accept the risk, meaning, and how do you know you accept the risk? Your behavior will tell you accept the risk because you don't have any problems putting the money in the machine. See, if you couldn't accept the risk, then you would find it difficult to actually put the money in the machine. Gambling forces us to accept the risk in advance, because if we don't, we can't play. You can't sit down at a blackjack table and just decide to play and without putting your money out there first. They won't let you. But the illusion that analysis creates with trading is that I can actually get into a trade and believe that I'm not taking any risk. And if the market happens to go in my favor immediately, it's without giving any heat. It gives me, it reinforces the idea that yes, I can do this without risk. I can do this without risk. I don't have to experience this if I just find the right method. That method doesn't exist. Get it in your brain. It doesn't exist. If I had a method that produced 99% winning trades, I guarantee you, if you're risk adverse and you haven't accepted the risk, you will not make consistent money. You'll always be worried about that one time. That's why, you take a trader who, has, 9 out of 10 winning trades, maybe 4, 5, or 6, or 7 in a row, and you're talking to other traders at conferences and chat rooms, and they'll tell you about all these winning trades that they had. They didn't tell you that the 10th trade, they lost all their winnings on the first 9 and more. They didn't tell you that. Yeah, 9 out of 10, 9 out of 10, yeah. And do they have to lose all their winnings from the previous 9 trades? Did it put a stop in? No. Did it define the risk in advance? No. And why didn't they define the risk in advance? Why did they not put a stop in the market? Because they thought they had a guaranteed win. It's that simple. Do you think that people could sit there and play slots for hours if there was the emotional risk? If there was the emotional risk that traders have about if they're wrong or they lose, they're going to tap into that pain. We don't enjoy that. It has to be enjoyable. The emotional risk of playing slots for most people just doesn't exist. They're enjoying themselves because they know the outcomes are random. They know they cannot, it is senseless, it would be an effort in absolute futility to think that they're going to predict what the pattern of those wheels are going to come up with on the next spin. They might not know anything about the architecture of the computer chip that generates the random outcome, but the point is, it is a purely random outcome. And when we learn that it's purely a random outcome, the whole idea of predicting or even being right or wrong is irrelevant. It doesn't apply. Does not apply. And so it takes what we're doing, the activity, out of a right or wrong context. And so I can sit there and push the button, and there's nothing to be right or wrong about because I'm not predicting the outcome. Now, that's a little bit more tricky in trading because we're using an analytical process to actually make a prediction. But what we have to do is we have to apply the principles of the law of probabilities on that prediction and say, you know what? This is a prediction, correct? Okay? I mean, this is, yes, I am making a prediction. I don't have any illusions about the fact that I've used this in an analytical process. I've come to a conclusion. I'm making a prediction. But you know what? It's still just a guess. And in that way, we're not responsible for what the market does after we put on a trade. How can we be? When you understand order flow, when you understand there is no way that I can predict the intent that other traders have after I get into a trade. There are other traders all around the world waiting to enter orders for whatever reason pops into their brain. Whatever agenda they have, whether it's commercial, whether it's contractual, whether it's hedging, or whether it's pure speculation, they have their reasons for sending a buy or a sell order to the exchange and how big that order is. There isn't anything that we're doing from a technical or even fundamental perspective where the mathematics of our system can predict what those guys are going to do, or women, okay? There's just no way. In essence, I'd have to know who's about to send an order to the exchange, what kind of orders are going to be. Is it going to be a buy or a sell? How big is it going to be? And then with that, you could say, okay, well, we've got all these buys coming in, we've got all these sells coming in, and so in this moment right here, we should get an uptick. But then again, let's say in the moment there's a huge abundance of buy orders coming into the exchange that overwhelms the number of sell order inventory to take the other side of those trades, and the market starts to shoot up. But then some other trader somewhere in the world sees the opportunity to what he thinks is sell high and just slams that rally with a huge order. Now you would think, well, who could trade that big? Well, hedgers can trade that big because they're not taking the risk. They're eliminating the risk. They're already long or short. They're already what I call naturally long and short based on their business. So yeah, they can put that big of an order in the market and actually defend a price. You heard words like defending a price? This is what it means. You tell me how a mathematical equation is going to predict that. Somebody please. But that's exactly the way you trade, isn't it? Isn't that exactly the perspective in which you take? You think that this mathematical equation is going to accurately tell you every single time what the intent of all these other traders are around the world? It's just a probability game, everybody. That's it. And analysis makes us think it's something else because of the erroneous and connections that we make and erroneous assumptions that we make. It's like, yeah, okay, again, I've said it again. I did my analysis. I made a prediction. The prediction was absolutely correct. So the reasons why I made the prediction must be the same reason why the market went in my favor. And that way, I knew what was going to happen. I knew what was going to happen. Making us think that the risk cannot exist. If you're trading to avoid being wrong, if you're using analysis to avoid being wrong in any capacity at all, even just the tiniest bit, if you're using analysis to avoid being wrong and avoid losing, it doesn't work. The only way you're going to make this work is to adjust the way you think, is to change your perspective, that what you're doing doesn't have anything to do with, you're going to need, your predictions have to be correct, but your reasons for making the predictions do not. In most cases, for the typical screen-based trader, most of the trades they put on, there's virtually very little correlation between the reason why the market went in their favor and the reason why they put on the trade. Very little correlation. And what do I mean by correlation? How would I find that out? I would have to be able to inventory. If I went long based on a moving average, and my moving average crossed, and I put a buy order in the market, and then 3 or 4 minutes later the market started rallying, and I'm thinking that I have the right reason for making this. My technical reasons must be correct because it made the correct prediction. I would actually have to go out and determine all the traders who put buy orders in the market that actually caused my trade to become a winner, because I couldn't make my own trade become a winner. I can't trade at a level where, for example, if and there are a lot of traders who can, a lot of traders who have strategies to do exactly this. Okay, that when they see how many bids and offers there are at certain price levels, at certain significant reference points that they know they might be able, like I said yesterday, like stampede people out of a position or even into a position that helps them out, okay? All they have to do, if the price is at 10, all they have to do to bid it up to 11 is just simply take out all the offers. If there's X number of offers at 11, all they got to do is hit them. That's it. And the price automatically goes to 11. Then all they have to do to get it to 12 is hit all the offers again. That's it. They're actually creating their own price movement. They know why the market's moving. They know why it's moving because they're doing it. And they are making their own trades winners because everyone who took the other side of their trade at 11, when it gets bid up to 12, is a loser. Everyone who took the other side of their trade at 12, when he bids it up to 13, is a loser. Now, this can be a dangerous strategy. You have to have a lot of capital and a lot of balls, because as their position size grows, for them to get out of that trade, what do they have to do to get out of that trade? They got to reverse everything. In other words, they have to become sellers, which means that if they have a huge position that they built, a huge long position they've built up, there has to be buy inventory for them to get out of that position. In other words, they become sellers. And if there isn't enough buy inventory for them to get out of that position, they can actually force the price right back down again. That's what they, hey, yeah, it's like, right. There's a very famous guru on TV, I'm not going to mention his name, but about 6 or 7 years ago, he was doing an interview on the street, as a matter of fact, and kind of bragging, actually, before he became really famous. And he talked about a strategy, and this is something it's probably still done. I don't watch the markets enough to really say, but it's like if you watch to see what kind of orders are flowing, the size of the orders that are flowing into the exchange towards the close. So let's say we've been in an uptrending market, and it's like retail traders who need the most confirmation. They're the most risk adverse, so they need the most confirmation that something's going to work. Okay, so to get into a trade. So this is a particular stock, for example. So they see a lot of 50 share, 100 share, 200 share orders flowing into the exchange on the close. What do they know? They know a lot of retail people are buying into the whole idea, right? So what they're going to do is, they're going to see what kind of bids and offers are lining up before the close or before the open the next morning, and he would say, hey, you know what? Depending on the stock, he might have to allocate, anywhere from $30 to $50 million to take out to take out all of the bids. So let's say the market is slated to open right here. He might allocate 50 million or whatever it took to take out all the bids to drive the price down in the open at the open. And all those, not all, but many of the people that bought on the close the previous day, this was the close the previous day, they're going to think, oh my God, what did I do? They're going to start selling, okay? Their sell orders are now going to help create this downward movement because there's an imbalance between the number of the buys and the number of sells. And as soon as they start coming into the market with their sell orders, he reverses his position and starts taking the other side of those sell orders as a buyer. So he was able to get in on this trending market, for example, at a lower price. So you just force the market lower, he gets in at a much lower price, and then the market just reverses back up again and keeps on going. This is a valid strategy that people have been using for years. I mean, this doesn't surprise anybody, does it? So it's like you got to be able to do this. You got to be able to do it. You got to be able to get yourself into an emotional state of mind, like a person who's playing a slot machine. It's like, how do I lose without feeling like a loser? Real simple. You're not losing. This business requires expenses. Now, you're laughing, but it's true. You think that's the way? You think the casinos, the board of directors and the management of casinos, when they're looking hand by hand, they're saying, "Oh my God, we lost $1,000. Oh shit, we just lost $5,000. What am I going to do here? What am I going to do?" These are expenses. The amount of money that we pay for the trade, the edges that don't work, is simply the cost of doing business to make ourselves available for the trades that do. How many people in this room have ever owned a business? When you had to buy supplies, when you had to buy pencils or office supplies, did you feel like a loser writing that check? Did it tap you into this pain? I'm such a loser? Would it even occur to you to think that way? But yet you think that way now. Why? Why do you think that way now? Come on, why do you think that way now? What? Yeah, but no, why do you think that why does the potential exist for you to experience a losing trade and tap you into the pain of what it means to be, what it means to lose? Why? Yeah, because you think you know what's going to happen. You think you knew what was going to happen, and that it shouldn't be happening. Because I have an expectation. I have an expectation that is not in line with the reality of the environment that we're operating in. You're not thinking of it as an expense. I've got X number, my edge. Like I said, my edge, I've tested my edge. I have a certain expectation about what the outcome would be. In other words, over a series of trades. But I don't know what the outcome is going to be on each individual trade. And it goes as far as this. It's like if I said, I'll give you an edge that has a 70% win-loss ratio. 70% winners, 30% losers. Would that imply to you that on each individual trade, there's a 70% chance of winning?
Yes.
Absolutely not. No. 100% no. There is no way to calculate. Think about this. Think about what I just said 5 minutes ago. There's no way to calculate the odds of any given individual trade working because we don't know what the intent of other traders are. If I don't know what the intent of other traders are, how in the world can I calculate the odds of any given individual trade? I can't. It's impossible. I can be ready to put on a trade where it's destined, what I mean by destined, it's destined to lose the instant I get filled. And why? Because I don't know that some big hedge fund manager is going to unload a whole half his inventory of a particular commodity or stock in the opposite direction of my order. How would I know that? That his order's coming down the pike 1 minute after I get filled. How would I know that? And if I can't know that, then how do I calculate the odds of success of that trade? I can't. That means the risk always exists. I can't even calculate the odds of success of any given individual trade. And when I do, it would, let's say, in the discretionary mode, it would be based on my experience, but in essence, I still know I'm guessing. I can say, yeah, I think this trade has a good likelihood of working out based on the pattern. And at the same time, if the pattern, whatever pattern I'm looking at, whatever's going on in the market in relationship to, let's say, news or anything else like that, I still don't know what that one individual trader might be doing or intending to do. Keep in mind that the patterns, the collective behavior patterns that give us our predictions are consistently show up over and over and over again, and they are reliable. But it only takes one trader somewhere in the world, just one trader somewhere in the world, to negate the positive outcome of that pattern. We have an expectation based on the pattern. It only takes one trader, just one, unloading a huge order within minutes or whatever after we get into our trade. That's all. Tell me how you're going to predict that. Tell me how you're going to calculate the odds of that trade working.
The average rate is by itself.
It is not a 50-50. I'm going to stop you right now. There's no way you can say it's 50-50. There's no way you can say it's 50-50. Oh, I just said that a trade could be destined to lose. There's a virtual 100% certainty that you will lose, even before you put the trade on. So how's that 50-50?
What I'm saying is that, yes, that's what you're saying is true in terms of we can't predict it, but within the context of probabilities based on our analysis, we have to make a decision based on that with the risk.
Yeah, you have to make a decision, but keep in mind these decisions. You have to expand. You have to expand your perspective. You want to make this decision on a trade by trade basis. What I'm saying is that we're going to expand our definition of success from a trade by trade basis. This is trade 1, trade 2, 3, 4, 5, 6, 7, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, to what I call a sample size of trades. In other words, I am not concerned with the outcome of any particular individual trade within the 20 trade sample size. What I do is trade in 20 to 25 trade sample sizes. And what I mean by that is that I'm saying to myself, I'm based on testing the particular variables that define my edge. I have found that I've got, let's say a 60-40 win-loss ratio. And we're not talking about, and how you profit in relationship to, into what your expenses. But let's just keep it at a 60-40 win-loss ratio. And so I say to myself, what I'm going to do is I'm going to take the next 20 trades and find out what my results are. Now, I like trading in 20 to 25 trade sample sizes because what you want is your sample size to be large enough to adequately test your edge. You want it to be small enough so that if your edge starts deteriorating over time, because we're dealing with a fluid environment, edges can get better and edges can get worse. And you want to be able to stop your sample size so that if your edge is actually deteriorating, you can change the variables before you lose too much money. But you got to take this expanded view that I'm not trading trade by trade anymore. It's over a series of trades. And so if I like my outcome at the end of 20 trades and I look at what my outcome is, what my profits and losses are, if I like what I experience, I take another 20 trades. I do not, under any circumstances, change the variables within the sample size, because that would be trading randomly. I'd be adding random variables that will skew the results. But if I like the results, then I'll take another 20 trades. If I don't like the results, since I know exactly what I did and why I did it in every single trade, I can go back and look at my variables and say, you know what, if I tweak this, if I just take a little bit more risk on each one of these trades, I actually would have been in more winning trades and experienced more profit. Or I can even see that I might not have to take as much risk. Or if I just move my profit objectives a little bit further away or a little bit closer. In other words, you're trading, instead of trading randomly, you're trading systematically. Because you're going to learn what works and what doesn't. As long as you're adding random variables into your equation, you never learn what works and what doesn't. You will over a period of time. It might take you 5 years or 10 years or whatever, but you can cut that learning curve back, real quick. Just stop trading randomly.
Well, that is that your variables may not change, but all the things that you're betting on or you're investing on, those variables are changing. So
That's why we trade a limited sample size. That's exactly why. You're right.
when you do when things are going bad, and they've got 12 or 20 wins. The next sample size that you're running might only have 8 out of 20 wins now. Is that statistically significant or not?
I think so, yeah. I think that usually between 20 and 25 trades, if it isn't working, I'll change the variables.
One strategy, but
Same thing. Yeah, absolutely. Yeah. So when you expand your definition of success from trade by trade to a series of trades, then the outcome, you become detached from the outcome of each individual trade. It doesn't matter. What I'm concerned about is my end result at the end of the sample size. Because the most important part of this, once you have your variables that define your edge, the most important part of after that is being able to execute. Can I execute flawlessly? In other words, can I get into these trades exactly when my edge says to get in? Or am I going to get in late because I think, I don't really think this is one's going to work. Now, and then it starts to work, and next thing you know, I'm chasing the market. Or am I going to get in too soon because, the last time, it's like, the market didn't really come down and hit my price, and I missed out on a trade, so I'm going to get in beforehand, and it turns out not to work. It's like all these ways that we can make errors deteriorate my results. Because I know there isn't one person in this room who hasn't seen the possibilities of being able to execute an edge over a series of trades and not have more money. And if the only reason why you don't is because you're not executing your edge properly. Because look what happens when we're trading with fear. See, this can only be done in a carefree state of mind. I can't care about the results. It can't matter. And if it doesn't matter, then I can get in exactly when I need to get in. I can get out when I exactly need to get out based on the tested variables that define that edge. And then I can experience the true potential, profit potential that edge has built into it. I can then experience the true profit potential that edge has built into it. The same way a casino does. Casinos execute flawlessly. Do they not? I'm not saying dealers don't make mistakes once in a while, but for the most part, casinos execute flawlessly. As traders, we can't execute flawlessly because, why? We think we know what's going to happen. And if we think we know, it's because we think we can know. We think we know, and we think we know because we think we can know. Once you start getting it firmly implanted in your mind, it isn't even necessary to know for you to be consistently successful in this business. You'll start letting the idea go. Go ahead.
What you need to do both, or is that something older we should reinforce?
Both. Taught both. Definitely in Trading in the Zone, Disciplined Trader, and reinforced and taught in different ways in the new book, yeah. But you can see, it's like a lot of people in this room have been trading in the zone. Am I saying anything you haven't read?
No.
And yet it's still like, it's still like resonating like, this is getting too real. This is just getting a little too real. Yet you've already read it. Go ahead.
The reinforcement of this is helping you understand why said, great anyway.
Right. Yeah. Yeah, the whole idea of trying to figure out why you're wrong with mathematical equations or even fundamental analysis is such an effort and futility. It's when you really understand order flow, it falls into the category of being absurd. Because until we can find out who placed the orders and why they did it, we'll never know. I'm not saying some people don't know or some people can't find out. I'm saying as typical screen-based traders, it is completely out of the realm of our reality.
I'm a 26-year owner.
Oh, what?
A 26-year registered nurse.
Okay.
And if I have a patient with diabetes and the blood sugar is not stabilized, someone comes back to me and says, Vic, what is going on with this person? And I say, well, she's diabetic. Instead of eating a piece of watermelon, she ate the whole dang thing. I can give you a reason for that outcome. And it just feels so good to be released from having to have a reason for the outcome.
Yes.
Follow the methodology.
Right. You see, this is something, you hear what you just said? Have you not read that over and over again or heard that over and over again?
In your books.
No, not just in my books, but just even other places, right? And yet, now it's sinking in, right? Okay. See, everyone is a certain psychological distance away from not only one, being aware of these concepts, 2, understanding these concepts, 3, embracing these concepts, and then actually assimilating these concepts at a core level of their identity so that they become a part of their personality. And it usually happens in stages. It doesn't have to. All of us have probably, had experiences where we made, seismic shifts in our perspective instantaneously. It can happen instantaneously. It really can. When people have like an epiphany, it's just like they're a different person from one moment to the next. Changing is not a function of time, by the way. We usually think that it is because if we want to change, we're gonna usually employ some sort of technique, and technique implies doing something over a period of time or a process. It's not a function of time at all. It's a function of desire. It's simply a function of actually focus, clarity, and desire. In other words, once you're really genuinely clear about how you want to change, and that clarity is sincere and resolute, and depending on the degree of desire, the change can happen instantaneously. Unfortunately, as traders, we get the idea, once we get the idea implanted in our brain that analysis can take away the risk, these beliefs become so entrenched and so powerful that it takes having to lose fortunes several times over and really painful experiences to finally come to the conclusion or the awareness that, this isn't working. That's the common thread that you hear everyone that's broken through that threshold tell you about. What I'm here to say is that it doesn't have to be that way. You can make these changes in your perspective at a conscious level. You can take control of this process, and you don't need pain to have to go through it, or to even prompt you to do it for that point, for that matter.
So analysis can't become this.
No. No. They can't do anything with respect to the risk. No. Yeah, analysis, yes. Managing the risk is different than accepting the risk. I'm talking about accepting the risk from a psychological perspective.
Use analysis to manage this.
Yeah, we use analysis to manage, position size and how far we're going to let the market go against our position to tell us that the trade isn't working or we're spending any more money to find out with respect to the profit objective. Yes, what I'm saying is accepting the risk at a core level where it essentially doesn't. I'm not really confusing guys if I say it that way. That it doesn't matter. Where you can get in and out of a trade without it resonating the slightest bit of emotional discomfort, no matter what the outcome. That's accepting the risk. You can get in and out of a trade regardless of the outcome without it resonating the slightest bit of emotional discomfort. Do you understand the distinction, the difference? People sit at a slot machine for hours and they win and they lose without it resonating the slightest bit of emotional discomfort. They're having fun. They're losing and having fun. And it's only because of their perspective. Because they don't define what they're doing as losing. They're spending money to have fun. And for the possibility that, they're going to get surprised and get money. This isn't any different. It really isn't. The order flow has the same impact on price movement as a random chip generator in a slot machine. And if anybody disagrees with that, tell me how and prove otherwise.
Are you also saying like assimilating these concepts where they become core to our personality? This extends beyond our training.
You could, yeah. Well, when I answered somebody's question yesterday about why people didn't do the exercise, I answered that question within that context, and I was actually sorry that I did. Yes, you're right. Because what ends up happening is that once we realize we can take conscious control of what we believe and how we experience our lives in trading, what's going to stop us from doing it in other parts of our life? And it's not a matter of what's going to stop us. It's like then we don't. A lot of our excuses start to melt away, and that can be pretty scary. The way I should have answered the question yesterday was that I didn't explain it well enough in Trading in the Zone. The reason why people didn't do the exercise, I really didn't, I didn't know that I didn't explain it well enough until I started in that same, that same material for this third book. And it's like, and then I started really breaking down my assumptions about what other people understood and how they were going to relate to this material. And then it's like it all hit me like, well, no wonder why they're not doing it. I didn't explain it well enough. Go ahead.
If I'm understanding it correctly, there's no motivation for a game. There's no motivation for pain.
I don't know where you're getting this idea of no motivation, but you're going to have to...
Well, look, I'm
the words you use... See, here's the problem. I'm sorry that I interrupt you, but the problem is that the words you use are important, okay? And it's like they imply certain concepts and principles that you're operating out of. So when you use the word motivation, it's like it implies to me that somehow or another what I'm saying is impacting your motivation to do one thing or another, and it has nothing to do. But anyway, go ahead. I'll let you finish. Go ahead.
But my motivation, right? So I'm either motivated to gain.
Why are you trading?
Because I love the journey. I love to.
And it's see, you say to make money, but that isn't the case with everybody. Why? It's like you can see the problem. The problem for me to answer that question is that what okay. Problem for me to answer that question is that we have to go into a lot more depth. It just isn't that simple. It just isn't that simple for me to say it just within the context in which you asked me. And I don't want to really say anything that's okay. So we can talk later. Okay. What do you mean, how does it? You backtest. Yeah. And in other words, you backtest a set of variables until you're satisfied with the results. You keep backtesting until you're satisfied with a set of variables that can produce an outcome over a series of trades that is acceptable to you. It's that simple. It's whatever you're satisfied with. It's that simple. It's just whatever you're satisfied with. And then once you are, then I'm going to get into more detail. I'm just really building up to this, okay? I'm going to actually answer that question a little later, so I'm not going to get into it right now. Who else? Go ahead. We got one over here.
So, and I said, when you asked me why you were trading, I said, for money.
Nah.
Does it make a difference?
Not necessarily. Just not necessarily.
Does it make a difference if it's for money or for changing your job or whatever the reason? Does it make a difference?
As long as that difference doesn't prevent you from doing what you need to do when you need to do it. In other words, if there are competing agendas that prevent you from executing properly, or distorting the information, or distorting the way you see the information, then it's a problem. But, like I think I mentioned even yesterday, it's like I work with, over the years, there are several traders that came to me for coaching, and, they grew up in a Christian fundamentalist background. That's, very powerful beliefs about, rendering services for being paid and to render services for what you're getting paid for. And, gambling just doesn't fit into that scenario. And even though they would try to convince themselves that they're not gambling, the reality is they are. And at a certain level, they know that they are, and they're not, and they're acting in a way not in accordance with their religious beliefs. And even though they do everything they can to, like, shove the expression of those beliefs into the recesses of their mind where it doesn't have any effect on the way they see the market and the results, guess what? It doesn't work. They have to be reconciled. So is that what you're talking about?
I think gambling, it is.
Yeah.
It is.
Right.
The reason to do it. I don't think there's anything wrong with it.
As long as you don't think there's anything wrong with it, that's all that counts. If you're not feeling any guilt, if you're not feeling any regret, then that's all that matters. That's all that matters. There's a lot of people who do it for other reasons than making money than what they would say. They would say they do it to make money, but that's not the real reason why they're doing it. They're doing it to be a hero. They're doing it to be the big man on campus. To impress their relatives, to impress their friends. The whole idea of making money is a byproduct, but that's not the real reason why they're doing it. Okay, then that's right. I'm not saying that it isn't. I'm not in any way implying that it isn't. But the problem is that people have a lot of different beliefs even about making money and about what money means in their lives. It's like you have a person that says, I'm doing this to make money, and yet I can't tell you how many traders I work with that have a threshold of how much money they allow them, how far they allow them their account balance to grow. And they get to this threshold, and they have a huge drawdown. They build it back up. Same almost to the dollar amount. Boom, dollar amount. And they can't get through it. This scenario has nothing to do with what's going on in the market. It has nothing to do with their edge. Now, if they're trading mechanically, the thing is, I'm not implying that you even have to know what these issues are. I don't want to scare you guys. You don't have to know what these issues are. And if you don't want to get involved with them, that's all right. You can still be very successful as traders. Just don't trade in a discretionary mode. Because, see, when you trade in a mechanical mode, you know exactly what defines your edge. You know exactly what you're supposed to do and when you're supposed to do it. There's no question about it. When you trade in the mechanical mode, the market has to conform to your specific specifications of your edge, or you don't have a trade, you don't have anything to do. So there's even nothing to think about. All the thinking was done when you did your analysis in your back testing. You decided what your edge was going to be and the variables you're going to use to define that edge, so all the thinking was done in advance. The market either conforms to your edge or it does not. If it does not, you have nothing to do and nothing to think about. Therefore, if you have all these other side issues coming into play, you don't have to know what they are. You just have to know, you know what? I'm finding it difficult to execute my system. Why can't I do it now? It's like, I'm supposed to get in right now in this moment, and you're feeling resistance. Or you're feeling resistance, putting your stop in the market. Or you're feeling compelled to pull your stop. That energy's coming from somewhere. You don't have to know where it is. But at least if you know that you're not doing what's appropriate, you can at least shut down and stop trading. Or if the desire is strong enough, step through it and do exactly what you're supposed to do. And every time you do, and I'm going to go into this in a little bit, every time you do, you start building and you start adding energy to your new beliefs about what it means to be a successful trader, and you just automatically start extracting energy out of the conflicting beliefs. And you don't even know where that energy is coming from. You don't have to know. You just have to stay out of the discretionary mode. Because the skills that you're going to need to trade discretionary are pretty sophisticated, at least to create consistent results. They're pretty sophisticated mental skills. They really are.
I'm a professional football player.
Okay. Okay.
And I know what the street's like.
Do you know what the what's like?
The street, the winning.
Yes, okay, yeah.
I've been to one. I'm positive. But I can go in one, I can go 10 days straight, losing, I'm going to lose you. But I mean, I'm all the way up. But after that, you can't say you're emotionally not affected after 10 days. Even though I'm a professional football player, I still get affected. And I could say, it's like the plateau. Once you get affected 10 days straight, you take for trading and trade it.
Right.
So you do have a tendency of winning. You do have to trade better. You play better. Correct?
Yeah, absolutely. Yeah.
But you can't say, it doesn't affect because
Well, I'm not saying that it won't. Again, I'm not implying that it's not going to affect you. But what I am saying is you have to be aware of it and aware of the potential impact it has on your ability to execute properly.
taking a break.
Yeah, taking a break. Yeah. You know what? That's a good idea. Let's take a break. If I set up an exercise where, let's say you had a coin and you thoroughly analyzed this coin. Looks like a normal coin, but you thoroughly analyzed it and found that it was unevenly weighted. What? Yeah, found a coin. Okay, found your coin. Yeah, it was unevenly weighted on the head side over the tail side, and you flipped it 1,000 times and found that it's going to come up on a percentage basis, tails 70% of the time. In other words, heads is going to flip down because it's weighted, and it's going to be tails 70% of the time, and heads 30% of the time. And, just happen to get into a situation where someone says to you, you know what, they let you flip that coin, your coin, and they say, because you say to them, well, you know what, I'm really good at flipping coins, and I can do better than 50-50. And the person says, okay, I'll give you $1,000 for every time you're right, but you pay me $1,000 for every time you're wrong. Now, what you're going to is you're going to a situation where, let's say over 10 flips, where you're gonna flip the coin 10 times in a row. Now, first of all, what is the likelihood? What is the likelihood that you would be right all 10 times in a row? Well, in this case with the weighted coin, it's better, but under a normal coin, it would be highly unlikely you'd be able to correctly predict 10 flips in a row. But you know that you have an edge, a probabilistic edge. So to take maximum advantage of the edge that is built into that coin, how are you going to bet?
You bet, Jim.
What?
Take that.
No. How are you going to bet? Now, what are you going to call on each flip? You're going to call tails 10 times in a row, right? You're not even going to think about doing anything but calling tails 10 times in a row. What are you expecting on each individual flip? No. What are you expecting on each individual flip? You don't know, right? But here's what you're really expecting. One, you don't know, but here's what you do know. You do know something. It's either going to be head or tails. You know that it's either going to be head or tails, okay? And you know that heads are going to come up and tails are going to come up. So in essence, you are expecting both heads and tails. You are going to go into the 10 flips expecting both heads and tails. So if you call tails and heads come up, are you wrong? Yeah, you called tails. Why aren't you wrong? You called tails. Why aren't you wrong? What?
You're waiting for the average.
Oh, you're waiting for the average over the series of flips. In other words, you're not wrong on each individual flip because each individual call is serving a higher agenda. The agenda meaning I want the 70% percentage, meaning that I'm going to end up with $3,000 most likely on average. So every time I call tails, I'm calling tails 10 times in a row. But every time I do and a heads come up, am I going to feel like a loser? Am I going to think that I was wrong? No, I'm serving a higher agenda. I want the 70%. When we develop and test an edge and find out that it comes up with a 70% win-loss ratio and say that I'm going to take the next 20 trades, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. Am I going to care about the sequence, the wins and losses? Is it going to matter what the outcome to each individual trade is? No. All I'm looking for is the bottom line at the end of 20 trades. That's it. This is what this is all about. when you can learn to think this way at the very core of who you are, you will be able to execute your trades flawlessly. It wouldn't even occur to you not to do exactly what you need to do in each and every instance. To the degree to which you cannot do it, in each and every instance, is the degree to which you still don't believe you don't have, as a core part of your identity, a probabilistic or functional belief system in probabilities. And I'm going to show you how to get it installed. Go ahead.
Okay, this assumes that you're safe, say $100 every time.
Bet on what? Bet on what? Okay, yeah.
You're betting, everything's exactly the same.
Yes, correct.
What time, okay, I'm betting on that.
No, remember, I set the exercise up very specifically. I said, what can't work?
Different amounts.
No, I just said, no, keep something in mind. You're taking out of context, okay? You're applying a principle to something I'm not talking about. All I'm talking specifically about how to play this, in a sense from a money management perspective. I'm just doing it from the perspective of what our emotional response is. This is just all based on emotional response. In other words, what's our perspective in relation to, in other words, we're operating out of certain perspectives, it will dictate a certain emotional response. If I'm operating out of a probabilistic perspective, then there's nothing to be afraid of. Yeah, this all has to do with our emotions and our response. In other words, understanding that what we believe is going to determine how we see the world. We see the world through our beliefs. The decisions we make are based on what we believe in relationship to the information we're exposed to. What we experience, in other words, how we feel about the results, or how we behave, will be consistent with what we believe. And how we experience our results, meaning what our state of mind is. Are we happy? Are we regretful? Are we elated? Are we joyful? Are we fearful? In other words, how we experience our outcomes is also a function of whatever beliefs we're operating out of. What we want to do is get to the point where our beliefs are completely aligned with a probabilistic perspective so that we can do exactly what we need to do, when we need to do it, unencumbered with fear. Because here's what happens when we're operating out of fear. I'm going to give you a real quick example, and I'm going to go into the whole belief system in more detail, and then set up the exercise. Okay. We got support, we got resistance, market comes back up, nice trading range, comes back up to resistance, coming down to support, okay? Now, I'm looking at this chart and I'm saying, okay, the market rallied off support here, essentially means what? An imbalance between the buy and sell orders. Why? I don't know. Who put the buy orders in to absorb the sell orders as it was coming down? I have no idea. I don't care. I don't need to know. It doesn't make any difference. Remember the example yesterday where, I had my customers buying support on an intraday basis, and it fell apart the next time because the guys who were supporting that price in the bond pit were out to lunch. And so as a result, their orders did not go in, their buy orders weren't there to go into the inventory, and there were more sell orders than buy orders. So whoever was selling it each time, in other words, whatever reason they had to enter these sell orders, they were not met with any resistance. I'm not resistance in the sense of, in other words, prices take the path of least resistance, and there weren't enough buy orders. There were enough buy orders to absorb those sell orders, and so and then more buyers came into the market or whoever. And then the market came down again, they were out to lunch, so it fell apart. Now, here we're in a situation where now the market's coming down to support, and I'm a typical trader operating out of the fear of being wrong, the fear of losing money, the fear of missing out, the fear of leaving money on the table. Okay? And as a result of not having learned how to think in probabilities, or having realized that this is what this business is all about, that analysis will not prevent the experience of me tapping into the accumulated emotional pain of what it means to be wrong and lose money. That analysis cannot prevent that from happening. So what I have to do is I have to take it out of a right or wrong, win or lose context. And this is what we're doing here. We're taking your trading, we're redefining it so that you have no reason to associate the experience of an outcome of a trade with what it means to be wrong. That doesn't mean that doesn't mean it has anything to do with whatever memories and beliefs you have that define what it means to be wrong for the rest of your life, or in any other part of your life. It just means that for trading, you're realizing this has nothing to do with being wrong. This has nothing to do with losing. You are you are incurring expenses. So you're not a loser. Take it out of the right or wrong, win or lose context, and you're going to experience freedom. And here's how. Because of the way these fears impact our perception of information and our behavior. Remember I said yesterday that fear causes us to focus on the object of our fear so that we end up experiencing the very thing we're trying to avoid. We'll actually create what we're trying to avoid just based on what we're afraid of. So the market gives us, at the most fundamental level, the market gives us two kinds of information to consider. There's a whole array of information, obviously. But at the very most fundamental level, you take it down right to the core, we have two types of information, two distinctly different types of information to consider. What are those? What would those two types of information be? Well, sort of. Upticks and downticks. Upticks and downticks, if that's simple. Right? There's an uptick and a downtick, an uptick and a downtick. Uptick, 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 downtick, downtick, downtick. Okay? Now, as we learn about behavior patterns and trading patterns, we learn things, we learn to make distinctions in the collective behavior. Distinctions being like, what do we call this? And from a technical perspective, what do we call this? An uptrend. And what do we call this? We call this a downtrend. Okay? So we actually learn to make these distinctions in the market's behavior that have meaning. Before we learn what the meaning of these patterns are, they are essentially meaningless. Meaning that we can, before we learn the distinctions, we can look at a chart and it's just literally random information that has no meaning until we learn the distinctions. So in essence, we build up these distinctions so that we can recognize what's already in our brain outside of us. So when it appears, we can say, yes, I know what that is. You guys with me on this? And so every other distinction that is possible in the market's behavior that we haven't learned about yet is essentially invisible. You guys with me on this? If we haven't learned to recognize it, it's invisible. So there are always opportunities available that are in essence invisible simply because we haven't learned to make the distinctions. So now I'm a typical trader who has learned to make this distinction and define certain patterns as an uptrend and a downtrend, and it has meaning to me. Because once an uptrend starts, I'm saying that, it's like I'll operate out of the principle, don't fight the trend is your friend, until something happens to say otherwise. And what's the real underlying meaning between the trend is your friend? You don't fight your friends, do you? You rarely get in fights with your friends. So don't fight the trend because it'll make you money. That doesn't mean you can't pick lows and pick highs. But trends are a good way to make money. And it's a distinction in market behavior. However, I'm a typical trader, and I'm operating out of this fear of being wrong and the fear of losing money. And so as the market's coming down to support here, I want to get into this trade. And so I put a buy order in, somewhere here, and get filled. Okay, I put a buy order in. The market goes up a little bit. Now, as a typical trader, I probably will not have predefined my risk. Because as a typical trader, it's like predefining the risk sets up an irreconcilable contradiction for me. Okay? It's like, I'm not getting into this trade unless I think it's going to work. Now, if I go through the exercise of telling me how far am I going to let this market move against my position right here to tell me that it's not going to work. In other words, in essence, it forces me to gather information that would tell me why, or tell me that this trade might not work. And I might gather so much information that I talk myself out of the trade. Has anybody ever talked themselves out of a winning trade? Okay, so, and talking ourselves out of a winning trade that ends up working is most of the times more painful than getting into a trade that just doesn't work. So if I've gone through this process of having talked myself by going through the exercise of trying to define the risk, meaning the dollar value that I have to assign this trade to find out if it's going to work, the dollar value of the distance between where I get in and structurally where I get out, and I've talked myself out of a trade in the past, chances are all I'm going to do is make sure that before I put my buy order in, I am really convinced this is going to work. Otherwise, again, why am I going to do it? So, in essence, there is no risk. I'm not expecting to lose. I am not expecting to lose. So, the market starts to go in my favor, and, then it starts to do, this. Now, remember I said the market gives us two fundamental types of information to consider, upticks and downticks? I don't want to be in pain, do I? I don't want an experience that taps me into what it means to be, all the accumulated emotional energy of what it means to be wrong, and my memories of what it means to lose. Now, the market's giving me two types of information to consider. It's giving me upticks and it's giving me downticks. If I don't want to tap into what it means to be wrong and what it means to lose, what of the two types of information that I'm being offered, what is going to what is going to have the most significance in my mind? No, you're not following me. You don't want to be in pain, people. You don't want to be in pain. Well, no. Now, this is an example. Don't get to that yet. I preface this with, this is the typical trader. This is not based on your new awarenesses of probabilities, okay? Okay. What of the information I'm being offered, I'm going to place more significance on one type of information than the other because of what it's going to mean to me emotionally. What information am I going to place the most significance on? The upticks. Why? Because the upticks take me out of pain. I'm expecting it. In other words, I'm expecting to win, and the upticks are taking me out of pain. So, for example, every series of downticks, I'm in pain. Every series of upticks takes me out of pain and gives me a sense of relief. Downticks, pain, upticks, relief. Downticks, pain, upticks, relief. Oh, it's finally all over. It's finally all over. But in the meantime, I'm getting a predominance of more downticks than upticks. In other words, I'm placing an inordinate amount of significance on the value of the upticks in relationship to the downticks, in essence, distorting what I'm actually seeing. I'm not actually seeing a downtrend. The downtrend has become invisible to me. I am capable of perceiving a downtrend. It exists in my mind as a distinction, but because of my unobjectiveness, because of the way my fears are impacting my perception, I am actually not seeing a downtrend. The downtrend is invisible to me because all I'm really seeing are these upticks. And so here I'm afraid of being wrong, and I'm actually creating the experience. I am afraid of losing money, and I'm actually creating the experience. It's all going on inside my mind. Eventually what will happen, and I went over this just a little bit yesterday, eventually what will happen is that this market will go down so far that because I'm just not operating out of the fear of being wrong here, I'm also operating out of the fear of losing money, that my fear of losing money will become stronger than my fear of admitting that I'm wrong. Because once I admit that I'm wrong, I get tapped into the pain. As soon as I come to the threshold of admitting, okay, I'm wrong, I get tapped into the pain. And what's shielding me from that is the fact that so far, my threshold for losing money hasn't been hit yet. Because when the fear of losing one more dollar becomes greater than my fear of admitting that I'm wrong, is when I'll get out of the trade. And then as soon as I get out of the trade, with nothing at stake any longer, I'll look at this downtrend and say, why did I just sell? I didn't sell because this distinction was invisible to me. This happens in degrees. Like, this is an extreme case, but this happens in degrees in virtually every trade we put on until we work through these fears. So let's say just the opposite happens. Let's say, instead of the market doing this, the market, does this. Now, who hasn't been in a trade, in a profitable trade? Now he's getting exactly what he wants. He's getting exactly what he wants. How far do you think he's going to let it? How far do you think he's going to let that go in his favor? What? No way. No way. How many times have we been in a winning trade where the market came back and took our profits away and ended up in a losing trade? Happen enough where, for example, he starts placing an inordinate amount of significance, in this case, on the downticks instead of the upticks, okay? Okay, it's like, the market's taking my money away. The market's taking my money away. The market's taking my money away. He'd never get to that level anyway. You'll probably blow out of it, right in here somewhere. So afraid of leaving money on the table that's exactly what he ends up doing. We can't be effective traders operating out of these fears. We have to find a way to operate out of a carefree, confident state of mind. Now, Johanna brought up something just after the break where she thought I was saying, or maybe implying that we have to give up both the idea that the negative and the positive. Meaning that, that trading doesn't really have anything to do with losing, so we don't have anything to be afraid of. That trading doesn't have anything to do with being wrong, so we don't have anything to be afraid of. But on the other end, that we also have to neutralize our excitement or our happiness or our joy from winning. Not the case. Not the case at all. People who play craps, they're spending money to have fun. They like being surprised when the machine randomly pays them off. That's fun. So no, we're not giving up the positive, but there is an issue that we have to address. There is such a thing as overconfidence. We've got confidence, and this is confidence, like this is fear way over here, and then beyond fear is terror. These are states of mind. They're all in degrees. And then beyond confidence is euphoria. Euphoria is a dangerous state of mind to be in as a trader. So what I am saying, making a distinction that yes, you do not want to be trading in a state of euphoria. Because in a state of euphoria, the risk doesn't exist. When we cross the threshold into a state of mind of euphoria, we don't have the capability of perceiving risk. And then we'll end up doing all the things we used to do when we believed the risk didn't exist in the first place. And if I'm implying that you have to develop some pretty sophisticated skills of self-awareness to be able to recognize when this happens, yes, I'm implying that. There's a lot about this business that, there's just no getting away from the fact there's a lot of skills to learn, and they're all psychological. After you learn how to read the markets, everything is psychological, everything. That's why you hear a lot of people talk about, trading is one of the best vehicles for growth and personal development that there is. There really is. Because it's very difficult to create illusions about the bottom line statement. If you lost 10 grand, you might be able to look at it and see, the minus sign isn't there and put a plus sign in your mind. But otherwise, it's pretty difficult. There's a lot of ways that we can create illusions about what's going on in our everyday lives. It's real tough as traders. You hear traders talk about, meditating. This is the reason why. Because meditation gives us a heightened sense of self-awareness. Meaning that what you're doing when you meditate is you can learn to become an objective observer to your own stream of thoughts. Because those thoughts have significance. And they'll give you indications as to what kind of state of mind you're in and what you're about to do. That may or may not facilitate your goals or be appropriate. You talk about traders who keep journals, traders who, used to be losers, went to the threshold, got to the threshold with consistency, and one of the reasons why is because now they're copious journal people. This is the reason why. Because keeping journals will give you clues and, give you clues as to where you are, what your state of mind is, and what other agendas might be, asserting themselves on your ability to see the market from an objective perspective. So we have to, Yeah, so is everybody, I just want to get a sense, is everybody really clear about the fact that we have to acquire a particular state of mind that allows us to trade without fear, and that analysis is not going to accomplish that? It seems like it can. Every time we we do analysis and we put on a winning trade, or we put on a trade and the market goes in our favor, it seems like analysis has done what it's supposed to do. And it's not that that can't happen. It's just that there isn't the kind of relationship between the outcome and the reasons why you put the trade on in the first place, where you can make that connection. It isn't real. It's an illusion. We're getting into that right now. I just want to make sure that we're all together on where we're going here. So you guys can write this down. Probabilistic principles. These are some of the things that the exercise that I give you in a moment, these are some of the things that you can say to yourself. In other words, these are these are actually core beliefs. Like, for an example, in trading in the zone, and something that John put up yesterday, like, a core trading belief that promotes consistent results is anything can happen. Every moment is unique. Now, we all understand that anything can happen, and we understand that, every moment is unique. But actually believing it at a functional level is another matter. And these beliefs, so when you can operate out of every moment is unique, it's like you're sitting at a slot machine, every moment's unique. You know that every single outcome is going to be unique, that has absolutely no relationship with the previous outcome. And as traders, when we're looking at a sequence of trades, we also have to believe that every outcome is unique, and those outcomes have absolutely no relationship with the previous outcome. We have to consciously disconnect. So if I get 3 winning trades in a row, it's going to feel like, if I'm not operating out of a genuinely probabilistic perspective, if I'm not operating out of the kind of perspective, it is going to feel like the next trade will be a winner. It's just the way our minds are wired to think. If I get 3 winning trades in a row, and I think I had, in my analysis, other than being a guess, caused me to have those, it did make the correct prediction, but the reasons why those predictions are correct are unknown. So there's no relationship. It's going to feel like the next one is going to be a sure thing. And as a result, we're going to be susceptible to a money management error, meaning that I'm going to put on a higher position, a larger position than what my account size would normally dictate. Or even be resistant to determining the risk, putting in stops, moving stops, making any number of those kind of trading errors. We have to learn how to disconnect. That each and every trade, regardless of the fact that the trade came from the same pattern that sets itself up over and over and over again, that each individual trade is just that. The outcome is a unique event. So if I get 3 losers in a row, and I get my next signal, what's it going to feel like? It's going to feel like it's going to be a loser, right? But the reality is, what? Well, slice idea. The reality is we don't know. If I'm doing the coin flip exercise, and I get, and I'm betting on tails every time, and I happen to get 3 heads in a row, am I going to stop doing it? No. The probabilities might not end up being 70-30, might only be 50-50 or 60-40. But the point is like, I know I've got the odds in my favor, so I'm going to take the next flip. I'm going to bet $1,000. We can't let our minds make these associations. There is no relationship from the outcome from one trade to the next. Absolutely no relationship. And the reason why we know that for a fact, why do we know that for a fact? I told you that this morning. Why do we know that for a fact? Yeah, we don't know what the order flow is going to be. We don't know who's ready to we don't know who intends to send orders to the exchange. We don't know the size, and we don't know what type orders are going to be. So there's just no way to know. So these are beliefs we're going for. And statements we can use in terms of like a self-talk, okay? Like, I'm completely reconciled to spend the amount of money my edge says is necessary to find out if this next trade turns out to be a winner. The next one. The outcome to each individual edge in a series is a unique event that has no discernible relationship with the outcome of any previous or future outcomes. Okay. That has no discernible relationship with the outcome of any previous or future outcomes. This is going to be a long one. The diversity of the intentions of other traders who are about to submit buy and sell orders to the flow can cause anything to happen. Since I don't know what that anything might be, I'm going to execute the signal my edge calls for and make myself available to either win and collect my profits or pay my expenses. Either way, I'm fine. The diversity of the intentions of other traders who are about to submit buy and sell orders to the flow can cause anything to happen. Since I don't know what that anything might be, comma, I'm going to execute the signal my edge calls for and make myself available to either win and collect my profits or pay my expenses. The very first one, I'm completely reconciled to spend the amount of money my edge says is necessary to find out if this next trade turns out to be a winner. Okay. And the last sentence of that one is, either way, I'm fine. The next one, the risk of an edge not working always exists. The risk of an edge not working always exists. You put always in capital letters in bold. Each prediction, next one, each prediction that results from my analysis is always a guess. Each prediction that results from my analysis is always a guess. The next one, capturing the favorable odds built into my edge over a series of trades. Capturing the favorable odds built into my edge over a series of trades has nothing to do with being right or wrong. Capturing the favorable odds built into my edge over a series of trades has nothing to do with being right or wrong. Now, how are we going to make those real? Go ahead.
Interesting example to what you've been discussing. Twitter, today somebody just announced that they've missed their earnings instead of doing it at the end of the market. Okay, so I have a trade on, and I'm losing right now a chunk of change, but what could I do? I don't know anything.
Well, why'd you put the trade on? Because of earnings? Or
yeah, I mean, yeah. But I mean, my point is that something happened that was beyond my call. I was doing what intellectually I thought was a good idea.
Okay.
And I'm just now just got a tweet saying that they've just dropped the bomb instead of waiting till after the market.
So you're not ready to buy a ticket to Rio?
No. I'm yet to get myself in that situation. But I'm just saying, it's just so frustrating because, but I'm listening to you and I think I'm feeling a little better. What can I say?
Good. Good. I'm glad to hear it. We got another one back there.
I think what you said is just great, but the only concern is you better have a good system or a good edge.
Yeah, if you're going to trade mechanically as opposed to discretion, subjectively, yeah, you have to develop a good edge. Absolutely. That's a given. The better your edge, the more money you're going to make if you can execute flawlessly. And there are a lot of good edges out there. There really are. Whether you develop one on your own or buy one or go into a chat room, they're out there. They really are. Anybody else before we go? Get the microphone. Wait for the mic. Well, they're going to be in the
To be fair to that young lady that bought the Twitter, to be fair to you, even though Twitter shares dropped, we don't know what's going to happen. It could go up, or it could go down, or it could, it can go up. You might have made the right trade. We'll know tomorrow. Nobody knows.
Okay, how are we going to make this real, everybody? Anybody got any ideas? How are we going to make it real? What? Oh, very good, very good, very good. We have to act on it. And so we have to set something up, right?
I guess the way to act on it is to put it down in writing.
And, we're going to do more than that. Yeah, we're going to do more than that. So, go ahead.
I would think that it would be to have these posted near your trading desk and to actually go through it before you execute any trade until it becomes natural, where you don't have these other thoughts that are creeping in. You automatically think about the risk of, an edge not working always exists, for example.
Yeah, the other thoughts will probably creep in no matter what. You can't stop those thoughts from creeping in. But what you can do is be aware of them and divert your thoughts to what you want to think. In other words, think thoughts that are consistent with who you want to be.
Yeah.
Does that make sense? Yeah. Have what? A quarter? Yeah, yeah. You mean like to remind you of the probabilities? Yeah, okay, sure. Okay, I'm going to get more specific though. Okay, I'm going to get real specific on how to do this, because what we're dealing with here is we're dealing with some pretty powerful entrenched beliefs, have a lot of energy, and so basically what we're going to do is we're going to step into a process where we're going to draw the energy out of whatever beliefs are inconsistent with these other principles and ideas that I just gave you. Draw the energy out and instill energy into these words to make them real inside of us. To give you an idea what I'm talking about, it's like in Trading in the Zone, I gave an example of a very common belief that a lot of people grow up with, where they believe in Santa Claus. So as a 5-year-old, that belief, I believed in Santa Claus, and that was a very energized belief. Energized in the sense that if I was in my bedroom and somebody knocked on the front door and my mom or dad said, "Hey, Santa Claus is at the front door," those words would have tapped me into the energy of what Santa Claus meant to me, all this positive, this positively charged energy that would have compelled me to go over any obstacle to get to the front door, right? That belief that Santa Claus exists and what it meant in terms of positive, happy energy would have dictated my behavior, and it would have been very difficult to stop, if not impossible. You with me? If those doors were closed and someone knocked on the door and they peeked and they said, "Hey, Mark, Santa Claus is at the door," what am I going to do? Nothing. That's probably some weirdo or whatever. It's like, I think it'd be, it's Vegas, highly unusual, but I don't care one way or the other. Where did the energy go? Why am I not behaving in a way as I did as a 5-year-old? Well, semantics is important here. I'm not going to disagree with you, but what's that? Oh, I have more knowledge. Okay. The truth set me free. Did it? No, what I'm looking for is energy. I'm looking for energy dynamics. Beliefs exist as energy. They're intangible. Intangible in the sense that they don't, it's like out of all the things that scientists have done in terms of mapping our brains and even at the cellular or molecular or atomic level, we still haven't actually found a belief. We know they exist, but they're not tangible in that sense. I mean, they're not made of atoms and molecules. At least the way I think of it, anyway. Energy is not atoms and molecules, and so I don't believe that beliefs are atoms and molecules. I look at them as being structured energy. Energy that's structured in a particular way that causes us to see the world in a way that's consistent with what we believe and behave in a way with what we perceive. We're going to take 5 minutes. Is it possible to draw energy out of a belief so that it doesn't have any impact on the way we see the world and how we behave? We might not know the underlying energy dynamics of how it happens, but we definitely know that it has to happen because there's anybody in this room that is operating out of the same beliefs and principles they operated out of as a child. Then, I mean, in other words, there's a lot of principles and things that we knew or thought we knew or believed as a child that we no longer believe because they're no longer useful. Whatever those beliefs are, whether we remember them or not, if we could do an inventory of all the things that we learned to believe at some point in our lives, we will find that a lot of those beliefs, just the energy was inadvertently drawn out of them. If the energy was not drawn out of them and we've learned something new that contradicts it, it's what I'm going to call an active contradiction. And many of us, all of us actually, can have a number of what I like to refer to as an active contradiction. For an example, in Trading in the Zone, I give this, about the boy and the dog. The example of the very first experience a child has with the dog is very painful. He's mauled pretty severely. And as a result, every dog that he encounters, throughout his childhood, regardless of how friendly the dog is, regardless of the potential fun that the child can have with playing with dogs, his perception of what dogs are is that they are mean and dangerous. At some point in this child's life, he will most likely, this is hypothetical, but most likely develop a belief, a series of words that he's going to put together that have meaning in the sense that they're energized as a living concept, that all dogs are dangerous. Okay? This is a belief. All is an example of a belief. It's an example of a set of words that we pull together into a concept that becomes a life principle that has energy. And that energy that's inside of him will cause him to see the world in a way that is completely consistent with these words. So that every dog he encounters, he will perceive as being dangerous and avoid, regardless of what the potential is, regardless of what the alternatives are. It won't matter. This is something that can really frustrate parents because they could bring home the friendliest, most playful dog imaginable, and it won't make a difference. And parents will get frustrated because they think that, somehow or another, the energy of their words is going to counteract the energy of this terror. Because that's exactly what the child experiences every time a dog comes into his field of awareness. And this can go on like this for the rest of his life. At some point, he will most likely become exposed to a friendly dog situation. Now, I set up a hypothetical situation in the book where he's just, walking with his parents. He feels safe, and they walk around a corner that, he can't see what's going on, and all of a sudden he's confronted with information that is completely contradictory to what he believes is true. This is an absolute truth to him. It's not true from the environment's perspective. From the environment's perspective, dogs have a range of behavior. They're friendly and fun, and some can be mean and dangerous and everything in between. He walks around this corner with his parents, and all of a sudden he's confronted with a scene where several, I'm going to say kids his age, and it's important that the kids his age part is a part of this dynamic because he's going to relate to them. And he sees these kids playing with dogs and just having a great time. They're laughing and they're running and they're jumping, and everyone's having fun. This is completely contradictory to what he believes to be true. Were you going to say something? Anybody going to say something? Oh, okay. To what he believes to be true. This is now setting up the dynamics of what I'm going to call an active contradiction. He has an awareness that even though he might not relate to it in terms of the actual words, I believe that all dogs are dangerous. And he might say it that way. I mean, he just might, have this concept embedded in his brain with these words. What's happening is that his awareness that all dogs are not all dangerous, because he has a personal, direct experience to see that they're not, will start to chip away at that energy. Not enough for him to go approach a dog, not enough for him to play with a dog, but at least it'll chip away at it a little bit. Now, here's the important part of this, and this is the key element to any kind of personal transformation. It depends on what his intent and desire is. Now, if this kid, for whatever reason, he's relating to these other kids so much, and he gets so attracted to the fun that they're having, says to himself, I would like to be like these kids. I would like to be able to play with a dog. Not everyone's going to have that. Not everyone's going to have that attraction. But in this case, let's say this individual looks at this scene and says, you know what? They're having a lot of fun. And he's thinking, I want to be like that. Does that automatically mean he's going to be able to play with dogs? No. No, this fear is just way too intense. So he's going to have to set up a process, you might say, okay? Set up a process, like small incremental steps to be able to get to the point where he can actually interact in close proximity with the dog. And just real quickly, just how the fear attracts the object, the object of our cause of focus on object of fear, create the fear experience we're trying to avoid. Like this kid was, let's say, so afraid of dogs that he could even be walking out onto his front porch because some kids, his friends were in the park across the street or across the street at a neighbor's kid's house, and they're playing. He could hear a dog bark down the street, which under normal circumstances he probably wouldn't even be aware of. And hearing the dog bark would cause him to go back into the house. He created the experience. He wants to avoid dogs. He heard a dog that he ordinarily wouldn't be aware of, created an experience of terror, and walked back into the house. So how does he get through this fear to be able to express himself? How does he transcend his fear to be able to express himself in a way that he can play with dogs? It'll probably happen in slow incremental steps. In other words, now every time he encounters a dog, he will be seeing the dogs from a different perspective because he's already seen that it's possible to have fun. He just can't do it yet. And so every time he has a dog comes into his field of awareness and it turns out to be a friendly dog and nothing negative happens, he'll start building up positive energy into a new belief system that dogs can be friendly and fun. Yeah, I'm saying dogs can be friendly and fun. That implies some. Friendly and fun. Two contradictory beliefs. Every time he has a positive experience, he starts adding positive energy to this belief, to this concept, and he's drawing energy out of this one. Little by little, incremental step by incremental step. Eventually, if he does this long enough or it happens enough times, eventually they'll reach a threshold point. A threshold point in which the negative energy in this belief is probably equal to or close to the positive energy of this belief. And at that point, he might have enough desire to cross the threshold into actually petting a dog, into actually touching a dog for the first time in his life, other than the first one where he got mauled, which, but petting a dog, and the point at which he actually has physical contact, pets a dog, without it being a negative experience, it'll start drawing tons of energy out of this one right here, because then he knows for sure it's not true. All dogs are not dangerous. See, it's the all. It's the all part. It's not true. So it's not like the belief itself disappears. Do I still believe in Santa Claus? Yeah. It's a part of my identity. It didn't disappear. Once a belief exists, we're going to have it our entire existence. Once we formulate a belief, we'll have it. It's just a matter of how much energy is inside of it. That you can draw so much energy out of the belief that for all intents and purposes, it might as well not exist because it has no potential to act on how we see the world and how we behave. So the whole time that he's going through this process of drawing energy out of this and putting energy into this, he was operating out of what I call an active contradiction. It's just like, as traders, we have an active contradiction. Most people believe that because they're traders, they're risk takers, when all their beliefs are lined up in a way that's completely contradicts what they think they believe. The idea that we're risk takers is an illusion. That's just something I'm a trader, I'm a risk taker. If I'm a trader, I must be a risk taker. And yet if I analyzed everything I do and how I think, it would definitely indicate that, no, I'm not taking any risks at all. Otherwise I wouldn't be doing it. Just like people who play slot machines. If there was the same kind of emotional risk playing a slot machine as there is with people who trade, do you think that tens of millions of people around the world will be playing slot machines every day? Come on, Do you think they would or not? Absolutely not. They're losing and they're having fun. But because they're really not losing. They don't look at it that way. They're paying for their entertainment. They're paying for their entertainment. They're paying to be surprised. And it's all right. They're not losers. They're paying to have fun. As traders, we have to pay expenses. We have overhead expenses. This has nothing to do with losing. Get that firmly ingrained at the core of your personality and you will be free. So my friend over here says, the truth shall set you free, and it will. Are we getting the concept here? Now, is this kid, as he's going through this process, does he have to have some sort of a comprehensive understanding of the dynamics as I've outlined them to you? No. He just has to have what? The desire. The key to transformation is desire and clarity. Clarity first and desire. You have to know exactly who you want to transform yourself into and why. Our beliefs, beliefs just don't, they can go, you can draw the energy out of a belief instantaneously if there's enough desire. However, you have to be real clear about what it is that you have the desire of. It can happen instantaneously. With intense desire, clarity, and intense desire, it's like that. The degree to which you don't have clarity and desire, it will take time. And so I'm giving you a technique that takes time. There isn't anybody in this room that hasn't had a situation or experience in their life. I'm assuming there isn't. I really doubt that there is. There isn't anybody in this room who hasn't had the experience of making up their mind and things changed instantaneously. Genuinely making up your mind. That's in essence exactly what I'm talking about. When you really make up your mind with a resolute desire, with no conflict about what it is that you're making up your mind about, things change now. Anybody want to contradict that? You're going to argue with that with me? You can. No, I'm serious. If you do want to argue, I'll engage in an argument with you. Am I talking about anything different here? With this exercise I'm about to give you? If you want to instill these concepts that I gave you earlier as trading principles, you'll do it. You'll find a way to do it. If you don't, you won't. And it's that simple. If you can make the connection, you can make a clear, discernible connection between these principles that I gave you and the kind of outcomes you want to experience as a trader, you will do it. If your desire is to be a consistently successful trader. If your desire is to get out of the boom and bust cycle. And the frustration. But keep in mind, not everybody wants to be out of the boom and bust. Not everybody wants to be out of the frustration. There's other agendas that can be, be asserting themselves. I had an options trader in the options pit years ago that I worked with. I mean, this guy had, John talks about a hero complex. I mean, this guy had a real hero complex. He'd set up the most convoluted option strategies that were just so unbelievable, and yet, and he did it for the express purpose of just going through the process of being the hero, of unwinding it in a way where, he managed to make everything all right. In other words, at some point when he set these things up, it looked like it was going to be disaster, and then he'd find a way to work his way out of it, and that's what he enjoyed. He enjoyed the complexity of it. It didn't help his equity curve much, but that was a secondary agenda. Okay, it wasn't his primary agenda. So, you want to instill these beliefs? Here's the way you can do it. The first thing you're going to need is a truly mechanical system. And what I mean by mechanical, I mean absolutely, strictly mechanical, no judgmental wiggle room whatsoever. Every entry and exit is absolutely precise. The market either conforms to the criteria of your edge or it doesn't, and there's nothing to decide. It's either there or it's not. Meaning that my entries are precise, that you don't have to make a judgment. Well, is this really an entry? Do I have, do I have this and this and this to consider? There's nothing to consider. This can be a pattern recognition system. It can be a mathematically based system. It doesn't matter as long as your entry, the way you enter the market, either long or short, is absolutely based on precise rules that you don't have to make any judgment about. Where you put your stop for a trade that doesn't work has to be absolutely precise and in the same place every time. In other words, based on your entry rules, there will be a most optimum place to put a stop that says that, there isn't much point in staying in this trade once the market gets this far against my original position. That does not change over the 20 trade sample size, because you're going to trade in sample sizes. We're going to be doing this in a 20 or 25 trade sample size. So where you put your stop has to be absolutely precise and consistent, meaning in the same place every time. In the same place in relationship to your entry every time. Not the same place on the chart every time, obviously. Profit objective, same rule. Precise, no judgment. Now, how are you going to find this system? You can develop it. You can buy it. You get it out of a chat room. I'm not saying that this is necessarily an easy exercise. Easy in the sense that finding a completely mechanical system where that has, they exist. They really do. One of the things, when my new book comes out, one of the next projects is going to be to make available a number of absolutely mechanical systems that fit the criteria of this exercise that people can choose to use to do the exercise. So in a number of different time frames and different styles of trading. I've already got one. I got one that said the entries are really good. I just haven't made the excess precise in terms of stops and profits. So I am working on it. And is that going to be in the book? No, that'll be web based.
No, I'm
yeah.
sure.
Yeah, the book, because it's like there's no point in making these concepts available to people unless you're going to, also help them with the system itself. Normally, if this were 15 years ago, I'd have said, you know what, figure out a way. It's like, you trade for, been in the business for 30 some years, and you think that, it's like, you don't have to do everything. But yet, I realize now that, I'm really going to have to provide it. Or give at least people a way to find it. So it's just because the reason why it can be difficult. Not everybody is in a, let's say, has the personality makeup to be able to develop their own mechanical systems. It's just that simple. So yeah, I'm definitely gonna make, and not only that, not just me, but I will also, investigate other people who have already developed systems and, take the best ones and endorse them. Just say, hey, go here, go here, go here. So that you have this available, so that you can get right into it. So you don't have to worry about even developing it yourself, that you can just step right into the process of being able to do this exercise. So the next part of the exercise is to test. In other words, the only reason you're going to have these variables is they're going to be tested. You have to back test or forward test. So for example, if you have back testing capability and you're proficient at it, then you can go ahead and back test. If you don't have back testing capability and you're not proficient at it, then you have to forward test. So what I mean by forward test is you forward test in a simulated account. Meaning you want to find out what the results are going to be over. And believe it or not, you're going to forward test. I don't think you really have to forward test beyond 50 trades. All you need is about 50 occurrences of your edge to determine whether or not it's viable. You don't need to go beyond 50. So even if somebody is offering you a completely mechanical edge that you can buy in a chat room or otherwise, if they'll give you at least, at the very minimum 25, but if they'll be generous enough to give you a 50 trade sample, that would tell you whether or not you want to get into it. You guys with me on this? So you test your edge, and you find out what the results are. It's that simple. It's like how many winning trades, how many losing trades, and what your profit and loss ratio is. Because there are some edges, that you can have. They might only win 35 to 40% of the time, but their profit to loss ratio is so good that you're going to end up a net winner. And there are edges where you're going to win 90% of the time, but your profit to loss ratio, meaning you have to risk a lot to make a little. Where you might, let's say in the S&Ps, and I'm even speaking of one particular edge specifically that I know of, where they're risking 8 to 9 S&P points to only make 2 or 3, but they're winning 90% of the time. Now this might, this is. A lot of people wouldn't like that. That would be all right. Don't choose that edge. The important thing is that you get, once you decide that, once you found something that you think is, that you believe is viable based on your testing, then you're going to step into a process of actually executing the edge. Now, how you step into this process has a lot to do with your own innate, risk-taking ability. Meaning that there's a lot of people who are trading who are not natural-born risk takers. I believe that there are genetically people who are genetically predisposed to take more risk than others. And the ones that are predisposed to take more risk generally will make better traders, or easier for them to be better traders, as long as they can control themselves. If they can't control themselves, they're going to be the worst in terms of their swings and up and down. But otherwise, I also, have worked with people who are so risk adverse that they can't even execute a mechanical system in a simulated account where there's nothing at risk and actually do what they need to do. They can't do it. They literally can't do it. Not even where there's no money at stake. There's nothing at stake, and they still can't follow the rules. And if that's the case, then it's going to be challenging. Okay, it's that simple. It's going to be challenging. And so here's what you do. It's like, if you can't do it with money, if you can't do it in a simulated account, because the first thing is you really should do it in a simulated account. If you can let's put it this way. Here's the rule. The rule is that once you decide on an edge, trade at least one sample size in a simulated account. If you can execute that edge perfectly, and what do I mean by perfectly? You take every signal as it's given without making any errors. It's that simple. Your entries are without error, and your exits on the profit and on the loss side are without error. In other words, you can do exactly what you need to do when you need to do it. The only thing that's going to stop you from doing exactly what you need to do and when you need to do it are contradictory beliefs, or beliefs that would contradict what it means to think in probabilities. If you don't have any beliefs, or any beliefs that have energy, that contradict with the set of beliefs that I gave you earlier, then you will be able to do this perfectly. And I would say the likelihood of that is probably 0. And so you execute in a simulated account until you can do it perfectly. Now, why are we doing this? It's important because you're going to think, you know what? I'm going to take time away from trading to do, You're doing this to develop the necessary belief skills that you need to be a successful trader. You are going to be inadvertently, well, not even inadvertently, consciously drawing energy out of any conflicting beliefs, and you don't have to know what they are. You do not have to identify them. You do not have to go into some sort of personal inventory of your beliefs. You don't have to do that. You just have to be committed to do the exercise, and it'll happen automatically. Every time you do what you need to do, when you need to do it, in spite of the fact that everything inside of you is screaming something different, don't do this, and you step through it and do it anyway, you will be drawing energy out of whatever conflicting beliefs were saying not to do it, or to do it in a different way, and adding energy to your new beliefs about probabilities. Are you with me on this? In other words, step as best you can, with as much desire as you can generate, step through the resistance. And just do the best you can, and keep on doing it until the resistance goes away, because it will. There's an example in, and I didn't elaborate on this example in the Disciplined Trader, where there was a guy I worked with, he owned a couple of construction, this is back in the late 80s, he owned a couple of construction companies in Dallas. He was in his, mid to late 50s at the time, a real kind of a rough construction guy, right? He owned 2 construction companies, and but he started trading bonds away from the floor, getting his ass kicked. And so he said he's going to come to Chicago and be in the bond pit. He's going to be a bond trader. So he bought a seat, and he's trading on the floor in the bond pit and still getting his ass kicked. And somehow, I don't know if he read the Disciplined Trader, somehow he ended up calling me, and I started working with him. And one of the things that became apparent immediately is that he had no concept of how to identify an edge. And so at the time, what I did was I taught him how to identify intraday support and resistance in the bonds using point and figure charts. And so we did that for a couple of weeks. And he went down to the pit. And and he had his, and it just so happened that, and he had his support and resistance, and found that he couldn't execute. I mean, he could not do it. Literally just couldn't do it. And that, of course, that really bothered him a lot, because he's the kind of guy that, he tells someone to do something, expects them to do it, no mistakes, right? So anyway, no mistakes. And so what I did is I set this exercise up for him. And the exercise, now this guy's a multimillionaire, okay? And this exercise was really simple. And all he had to do was, we had support defined at a particular price intraday. We had resistance about 7 or 8 ticks up from support, whatever. It just so happened the first day that he had to do the exercise, the market opened up in between these two support resistance levels. Now, the exercise was that if the market's price came down to his support price, all he had to do was buy one contract. One contract in the bonds where one incremental tick was worth $31.25. And all he had to do was risk 3 ticks. In other words, he's going to risk less than $100 to see if this trade's going to work. And if he didn't get stopped out, then if the market went up to resistance, he had to get out of the trade and reverse his position and risk 3 ticks. In essence, whatever the market did first is what he was supposed to do. But in any case, all he had to do was risk $100. This guy's the kind of guy, he'd take a $100 bill and light a cigar with it. Seriously. He couldn't do it. Could not follow the rules. The market started coming down, and he got so panicked that it wasn't that the market, he got so panicked that the market wouldn't go down to his entry point, that he got in 2 ticks early. And then when the market went up 1 tick, he got out with a 1 tick profit. Okay? And what the market did, of course, it went down, hit his price, went up and rallied up to 7, 8 ticks up to this price here, and he did the exact same thing. He got in 2 or 3 ticks early. When the market went 1 tick in his favor, he blew out of the trade. Yeah. And so the next day, he didn't really necessarily want to be talking to me after not being able to, he was embarrassed and, that kind of thing. Next day, he does the same thing. So I didn't hear from him for quite a while. And then about, 2 or 3 weeks later, he finally called. And what had been happening is that he got really good at identifying these support resistance levels, these intraday support resistance, and he was actually making money, but he was still only hanging on for 1 tick. In other words, he was only hanging on for, every time just a 1 tick profit, 1 tick profit. And so he was calling to tell me that instead of learning how to hang on to his winning trades, he was going to compensate by upping his size. So instead of being a 1-lot trader in the bond pit, he's going to up his size to 25 or 30 lots. Okay? Now, the problem with doing that in the trading in the pit is that you're trading with a whole different group of guys. 1-lot traders are going to be trading with other 1-lot traders and some deck holders, but when you get to these upper levels, you're going to be trading with other guys, and if they don't know you or they don't like you, they can make life real hard for you. And I'm not going to get into the dynamics of the pit, but it's not like, what people think. But in any case, since they don't even exist anymore practically. But in any case, so he called back at the end, and I said to him, he didn't ask me for my advice. I did. It was unsolicited, but I said, his name was Jerry, and I said, Jerry, I don't really think this is a good idea. And he sort of grunted and hung up on me. So anyway, he called back at the end of the day, and he was in such a state of distress. Not only had he lost all his money that he made from the previous 2.5 weeks, I suspected that he lost, considering the level of distress, that he lost a lot more. And so it was so much, he lost so much, that he was genuinely at that point where he was saying, I'll do anything, and he meant it. He was so frustrated that he said, I'll do anything, and he really meant it. And I said, Jerry, if that's the case, then here's what you got to do. I want you to do exactly what you're supposed to do with 1 lot. And when you enter, when you hit support resistance, what I want you to do, once you're in the trade, I want you to actually put your hands in your pocket and watch the clock. And the market either hits your objective or you have to stay in the trade for 10 minutes, whatever happens first. In other words, I want you to put your hand, because with board traders, you trade with your hands. I want you to put your hands in your pocket and actually watch the clock, meaning I wanted him to be with his discomfort. Because as he watched those seconds tick by, as he would watch those seconds tick by, those seconds would be like days and weeks to him. He wanted to get out of those trades. He wanted to take his profits so bad because he believed that, even though he could see, he just had indisputable evidence that the market would rotate back to his, support resistance points, that his fear of the market taking his money away was so intense that, he couldn't stay in that beyond that one tick. So I wanted him to put his hands in his pocket, watch the clock, and stay with the discomfort. And after the first day, he didn't think he did very well, but I thought he did great because he did manage, to stay in the trade for 3 or 4 minutes. Considering that each minute was like an hour or two to him, that was a big deal. It's like it wasn't really 3 or 4 minutes in real time. In his mind, it was a couple hours. Okay, really. And so, but the thing is, he did do it. And it was amazing how fast his fears dissipated to the point where he kept on doing it. And there was also his positive self-talk. In other words, I told him what to say to himself while he's watching the clock. In other words, to divert his negative thoughts and consciously think positive thoughts about, he knows why he's doing this and it's going to be all right. He's going to learn how to take his profits and, et cetera, okay? And, it wasn't really, I don't remember exactly how long it took, maybe about a week or so, and he was fine. He was done. He turned out to be a really, really good trader. Not in the pit, by the way. He left the pit and just became an off the floor swing trader. But he turned out to be a really good trader. Drawing energy. I'd never had the kind of in-depth discussions with Jerry where I could actually identify and put into words exactly what beliefs he was operating out of that caused him so much fear. I didn't need to, but all I'm saying is that he never really opened up to me in that way where I could say I knew exactly, I could put words on whatever beliefs he was operating out of, but it didn't matter. I didn't have to, and he didn't have to know either. All he had to know was who he wanted to be. He wanted to be someone who could hang on to his winning trades, and he accomplished that by stepping through his fear and staying with the discomfort long enough to do that, knowing exactly why he was doing it. And so you want to instill these beliefs, you're going to do the same thing. All you're going to do is you're going to do this exercise until you can do it flawlessly. Now, if you can do it flawlessly in a simulated account, then you're going to step into a live account. Now, how big of a live account are you going to step into? Meaning, what's your size going to be? I would say you keep your size. Everyone's going to be different, but you keep your size at a level where it is virtually meaningless. Meaningless. When it was a simulated account, it was definitely meaningless. Now you've got real money on the line, and so if you're thinking, let's say you happen to tap into a really good mechanical system, and you're thinking, you know what, I did my testing, and I did my simulated. Okay, now I'm going to trade 1,000 shares of whatever. Okay, and you're not. And what you don't know yet is that just because you did it flawlessly in a simulated account, it doesn't mean that you reconciled whatever money issues you might have when you go to a real account, okay? So I would say for some people, and there are people that I've worked with, for some people, their risk issues were so great that they couldn't even trade one mini S&P. They had to go down to one share of stock. One share of stock. Because what we're doing here is this, is that if we're working in a 20 trade sample size, that doesn't matter. If I'm saying, you know what, I'm not just going to take the next trade, I'm taking the next 25. See, that's what I'm saying. I'm not taking the next trade, I'm committing myself to take the next 25 trades no matter what. No matter what. That means that, in essence, what that implies, we'll do 20, I'll just do 20. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20. First of all, I don't have any idea what the sequence to wins and losses are going to be. I have absolutely no idea what the distribution or sequence to wins and losses is going to be over the next 20 trades. But what I'm saying is that I'm taking the next 20 no matter what. I know exactly how much I have to risk to take all 20 trades. I've defined my risk parameters for all 20 trades because it's exactly the same. So whatever that aggregate amount is, if you add it up for all 20 trades, if I'm trading one share of stock, for an example, and my edge dictates that I have to risk $2, let's say I'm trading a $50 stock, and I have to risk $2 to find out if my edge is going to work, then aggregate, what am I risking on this exercise? What? 2 times 20 is $40. Yeah, $40 plus commissions. Can we handle that? You think so? You'd be surprised. You might not be able to. So in other words, what you're saying is that I am willing to spend $40 to see what's going to happen with the next 20 trades. Now, if your risk tolerance is greater, and you can trade S&Ps or trade the Dow or trade the bonds or whatever that risk amount is, add it up on an aggregate basis, and assume that if I had to take 20 losses in a row, I'm willing to spend that money. This is really important. The chances of you losing 20 trades in a row is about as great as winning 20 trades in a row. So in essence, it most likely is not going to happen. But at least you are ready to spend the money if it does. It's really important that you make that commitment. And once you can trade whatever level you're trading at in terms of position size flawlessly, up your size. And until you can trade that position size flawlessly, up your size again. And how do you know if you've gone too far? You start making mistakes. You start getting conflicting thoughts. You start getting internal arguments. So then you scale back. How do you know when you are ready, if you so choose, to transition into the subjective or discretionary mode of trading, where you don't have to follow specific rules? How would you know when you're ready to do that? When you can trade at a position size that you normally would want to trade at, that your money management principles would dictate, and you can trade at least 2 sample sizes flawlessly. 2 in a row flawlessly. And what do I mean by flawlessly? I don't mean that you're just executing flawlessly. I mean that it doesn't even occur to you to do what you're not supposed to do. The thoughts don't even enter your brain anymore. I'm really serious about this, by the way. That the thoughts of doing something other than what your rules call for, it doesn't even occur to you because you've ingrained these principles into your identity at such a core level that distracting thoughts they don't even come anymore. Or if they do, they're so irrelevant that you just immediately dismiss them. And when you are having problems and experiencing resistance as you're going through the exercise, what are you going to do? Focus on the beliefs that I just gave you, the ones you wrote down. These are the beliefs that you're energizing. These are the words that you're making real inside your mental environment so that you experience the world in a way that corresponds with these beliefs. Is this making sense, everybody?
Is it important to do these over a shorter time frame, i.e. like intraday trades versus something you might set up once a week?
Well, let's put it this way, Dan. It depends on how fast you want to get through it. It's like you must set up an exercise on monthly charts. It's like, and it takes you 2 years to get 20 trades. I mean, that's your preference, okay? It's like, remember, this is an exercise, okay? This is an exercise to instill beliefs that I'm categorizing as skills. These beliefs that I gave you, they are actually fall into the category of a trading skill. No different than being able to recognize patterns in the market. That's a skill. These are the psychological skills that correspond with being able to recognize those patterns in the market. Any other questions?
This is more of a comment, but when you said these are psychological skills, since 95% of trading is a psychological endeavor, this may be the only way to exercise those skills. It just made the connection that because this is such a psychological endeavor, these are the skills you need to train. You need to learn them and gain them.
If you want to be consistent, yeah. If you want to create consistent results. Remember, none of these skills are necessary if you just want to experience winning trades. None of these skills are necessary if you just want to experience winning trades. They are absolutely necessary if you want a consistently rising equity curve where the drawdowns are simply a reflection of trades that didn't work, edges that didn't work, as opposed to psychologically generated drawdowns as a result of mistakes. See, what this exercise does is it instills in you a sense of trust that you will be able to do what you need to do, when you need to do it, act in your own best interest without having to experience pain first. Pain is not having to experience pain to do the right thing is not a good way to trade. Back here first. Go ahead.
I think you sort of answered my question in the last two sentences, but one of the things you mentioned earlier was you've got to know or have an idea of what kind of a trader you want to be. And I was just wondering if you could talk about, how do you get there? But I think, you talked about sort of how once you've gone through this exercise of, these 25 trades or whatever, however many, you build confidence in your ability to execute those trades the way your system is supposed to give you the signals, etc. So I think, and at the end of that exercise, you're much more confident about, your ability to execute those trades correctly, and also that you will not pull the trigger at the wrong time out of some other hidden agenda that you may have.
Keep in mind something. This is difficult to convey, but it's hard to know what decisions you're going to make about what kind of trader you're going to be when you're on the other side of this. See, if you're asking me, how should I decide what kind of trader I'm going to be, I can't answer that question because it'll be whatever resonates with you. And it's hard to know even at this point what that might be because you're going to be a different person. You're going to be seeing and responding in different ways, and it's hard to know what you might be attracted to and what might resonate with you once those fears are gone. Does that make sense? Someone here? Okay.
So in this system, this mechanical system, is it fair to set stop losses and automatic trades to enter and exit, or do you have to do it yourself?
You mean do it completely automated?
Yeah, completely automate the entry and exit.
No, it isn't going to help you to automate it. Just do it yourself. Okay. Because you want to experience what you're going to experience when you have to do it. That's right. It's either or. There's absolutely no judgment, no thinking wiggle room. You shouldn't even be thinking. Thinking is a trading error. All the thinking was done when you did your testing and decided on what criteria defines your edge. Once that's in place, no thinking allowed. There's nothing to think about. Just do it. Yeah, usually this should all be in the same market. The question was, you should be in the same market, yes. Whatever edge you're using, if you're going to set up multiple exercises in multiple markets for whatever reason, if you want to do it that way, do it, but just keep it consistent, that edge as it applies to that market.
And time frame.
And time frame, absolutely, thank you, and time frame, right. Anything else? Okay, let's go have lunch.